have been experiencing one of the biggest and largest momentum markets that we have had since the late 90s.
I think we are in a little bit of a wait-and-see moment.
The volatility and the rotation that we're seeing among single names is healthy.
There's a chance we get a significant 5 to 10% pullback.
Looking into next year, we are more optimistic.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, adding to 3 days of gains, equity markets advancing as the end of the government shutdown nears. The bond market reopening with yields falling on weaker than expected economic data. And President Trump preparing to host a dinner with Wall Street executives, including JP Morgan's Jamie Dimon.
It's sort of an interesting mix of bedfellows, considering that President Trump has a love-hate relationship with Wall Street, with New York City, and particularly with Jamie Dimon. It comes after a series of different dinners that he's held with other executives. Think about the tech executives he held a dinner with back in September. A question of what role business plays in this administration and whether this is potentially President Trump's effort to get a channel check on the consumer and on credit extension.
Do you think we start a conversation about a 50-year mortgage with the bank executives later on this evening?
I can imagine that might come up, and if not President Trump, probably some of these bank executives.
Got to talk about a state of the U.S. economy as well. Some mixed data in the last 24 hours. ADP out with a weekly number, not great. Small business confidence, not fantastic either. Bond markets reopening, picking up on the temperature of that. Bond yields lower across the board.
What's fascinating is bond yields are lower and yet stocks are higher. So you might say, well, on one hand, the bond market is looking at the weakness. On the other hand, stock markets are looking past that to the boom that they're expecting in the first quarter of next year. Pick your poison. Right now, it seems like a lovely, beneficial mix, given the fact that the government's reopening and people are embracing the idea the Fed will have the confidence to cut rates, but hard to get a clear read on exactly what the implication is for risk assets and for markets more broadly.
Well, let's go through what we're hearing from corporate America and corporations around the world. AMD talking up data center revenue. Hon Hai out with a solid outlook as well. That's what's supporting this equity market story.
What's fascinating is a week ago yesterday, we got AMD earnings and they came out and they were better than expected. The forecasts were better than expected and the shares dropped. It highlights that after a dinner last night, the shares are up in pre-market trading because they could talk about their rosy forecasts. How much does this really speak to the fundamentals? And how much does this speak to a shift in tone, in vibes, that doesn't necessarily have a connection to anything in what these executives are talking about?
The vibes are better this morning, at least. The stock is up by 5% in the pre-market. The broader equity market higher by 0.3%. Coming up this hour, Matt Miskin of John Hancock as stocks look for a fourth day of gains. John Lieber of Eurasia Group with the House to vote on the reopening of the government. And Hugh Van Steenis of Oliver Wyman on rising investor angst over AI spending. We begin this hour with stocks rising as investors await the end of the government shutdown and the release of a lot of delayed data. Matt Miskin of John Hancock writing bad news is bad news, especially when it comes to the jobs market and a Fed being hawkish. Regardless, markets have a trade the headlines mentality that is far from fundamental. Matt joins us now for more. Matt, that last line, what did you mean by that?
Well, I was just talking about you guys mentioning vibes here. It's a vibe market, and it's all driven from sentiment for the most part. And really what we're seeing is this jaws kind of presenting itself from the weaker economic data and the markets continuing to advance. You know, at the end of the day, sentiment is a very powerful short-term market force. And we are seeing momentum investors around the world really allocate towards stocks because they're rallying. Even in these mornings now, you're not even getting necessarily a narrative of why things are up other than it was up yesterday. And so we really see it even at the beginning of the week on Sundays. It used to be Sunday Fun Day, and now it's Sundays are a time where markets open, and there's usually some sort of headline that hits the markets first thing. So Monday morning we open stronger, and that sets the vibe or the tone for the week. In our view, this is a time where you want to think about more defensive or conservative options for portfolios and not to really overweight risk and over your skis in terms of risk at these kind of levels. But it's been a very strong year for markets, and we'll take it.
So, Matt, let's unpack some of this, and let's start with the data, the jobs data. How relevant is the jobs data to a market that's been driven by technology that is arguably holding back jobs data?
Yeah, John, I mean, this is the circular feedback loop that everyone's really highlighting is, it doesn't matter about the jobs because these companies are running more efficient. The AI is helping them increase earnings. And as long as those earnings are going up, that helps the stock market. Makes sense, right? Well, the missing linchpin of this argument is that you need the U.S. consumer to spend. There is no more powerful economic force globally than the U.S. consumer. And if the U.S. consumer doesn't have a job, they can't spend. And that's where we struggle to find this feedback loop and why we think that the weaker jobs data really is going to present weaker consumer spending. You're already having weak consumer confidence. Now, to us, this means the Fed will end up cutting more than the market thinks. Right now, the Fed is actually, in our view, overcompensating a bit because they think they're going to be more dovish into 2026. So they're being a bit more hawkish now. It is really fascinating to see stocks really kind of just float through that with minimal impact. But in our view, the weaker jobs data is very material for this economy and markets in time.
Matt, why do you reject the argument that in the beginning of next year, we're going to get tax rebates and all sorts of other stimulative measures that will really cause a boost to consumption?
Yeah, at the end of the day, the jobs market, like I said, is so important. And when you look at these, whether it's the Challenger layoff announcements or the ADP data, and you look at prior periods when it rose or when it caused the initial jobless claims to rise or the unemployment rates to rise, it's usually about a month and a half lag time between the initial layoff announcements and when it hits the data. And really, if you kind of time that out here, it's the beginning of 2026 when initial jobless claims start to rise, the unemployment rate starts to rise. And you think about this, the unemployment rate, the last data point we had was 4.3% in August. At 5%, usually that's a recession. And we're already likely ticking up. I mean, yesterday, Goldman Sachs said that more likely than not, we had a 50,000 job decline here in October. If that was actually the release of that national non-farm payroll report, in our view, that would have been a shock to the system. And so that's what I struggle with is if you're telling me that there's all these, kind of good things coming in the pipeline, the other side of this is we're still going to be catching up on weaker data that really hasn't been released here in the last month or so.
Matt, that R word was kind of jarring for me because I haven't heard it in so long, and no one's talking about recession. I mean, that seems to be nowhere on any of the earnings calls from corporate executives across the spectrum. We're not hearing mentions of an economic slowdown or anything like that. It really has come in at the slowest pace in terms of mentions of that going back to 2007. What does conservative mean in terms of investing? Does it mean just hide out in the 10-year, or does it mean actually high value companies that are also facing pretty elevated valuations in addition to, yes, very steady cash streams?
Yeah, so at the end of the day, there are companies that are growing earnings. We do like higher quality companies. Quality has not been in favor this year. It's been more of a low quality rally. But in our view, we would position higher quality in the equity space. We are looking at infrastructure related equities. Across Europe right now, you're seeing Europe rally. Some of that is infrastructure related utility type businesses that are throwing off dividends. They've got great earnings. So infrastructure related equities is one way to do it. We are looking at in the bond market, like you said, I mean, we're still getting nearly a 5% yield here. And yields have come down this year. But if the 10-year did drop below 4%, which is support, we think there's more return potential there. So there's still a lot of income and return potential out of the bond market. In our view, though, on the equity side, we're more neutral on U.S. large cap. We're overweight mid cap to get more diversified exposure, better valuations, and we're underweight small cap because, frankly, there's just so much non-profitable businesses there. So it's a modestly below one beta.
Talk about vibes. The ultimate vibes trade of the year is Europe, dressing up 1% GDP as if it's the next best big thing. Matt, you really want to stay in European equities into 26?
So we would look to trim into strength here. And this year is probably years worth of returns. If you look back over time, I mean, whether it's Italy or Spain, I mean, Spanish stocks, who would have thought? I mean, the economy is doing great. So congratulations on that front. But really, the stock market there is trading almost like it's another entity. And a lot of these, markets are trading almost like they're just ticker symbols versus a company or a country. And we want to be mindful of that we're not really just day traders here. We're not just trading these for momentum. And we want to look at the underlying fundamentals. But yeah, Europe is on fire this year. European financials breaking out here. And again, that is a sentiment indicator. There's positive vibes globally right now.
Amazing rally. Matt, thank you, sir. Matt Miskin of John Hancock there. Spain up by 1% today. The IBEX on the year to date, higher by more than 40%.
The vibes are good in the stock market. When you take a look at the economic indicators coming out of Europe, not so much. Did you see the ZEW feelings indicator from Germany yesterday? It was terrible, right? So you start wondering, can the vibes feel really good in the stock market and really bad everywhere else? Globally.
The estimate for growth in Europe, according to the ECB for next year, 1%. For 2027, 1.3%. There's some work to do. Let's get you an update on stories worldwide. Let's get to your Bloomberg brief. Let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. The House of Representatives is set to vote on reopening the government after the longest shutdown in U.S. history. The short-term funding bill was reached after senators agreed to compromise on a plan that will fund the government through the end of January. The measure would reinstate federal workers fired during the shutdown and guarantee back pay for furloughed employees. Meanwhile, aides to President Donald Trump are considering cuts to New York City's federal funding after Zohran Mamdani's victory in the mayoral race. The White House is waiting on Trump to greenlight any funding freeze. It's not yet clear what programs could be impacted. Mamdani, for his part, says he is ready to work with the White House. And AMD shares are jumping in the pre-market, up 5.3% after the chip maker released a bold forecast for sales growth over the coming year. CEO Lisa Su predicts revenue growth to average more than 35% over the next 3 to 5 years, with data center revenue on track to rise by an average of 80% over the same period. Su went on to say the total AI chip market will reach $1 trillion by 2030. That's your Bloomberg brief. John.
Yahara, thank you. More from Yahara later this hour. Up next on the program, fighting for an extension.
Democrats will continue to press the case to say to our Republican colleagues, you have another opportunity to extend the Affordable Care Act tax credits.
That conversation up next with John Lieber of Eurasia Group, live from New York City this morning. Good morning. Three-day winning streak on the S&P 500, looking to make it day 4. Futures higher by 0.3%. Outperformance on the Nasdaq. The Nasdaq 100 higher by 0.6%. In the bond market yesterday, Treasury futures rallied on weaker than expected economic data. The cash market reopens with yields lower, down by 4 basis points at the front end, 2s at 355, 10s at 4.08%. Under surveillance this morning, fighting for an extension.
House Republicans, you now have an opportunity to actually take some action in an area of this healthcare crisis. Democrats will continue to press the case to say to our Republican colleagues, you have another opportunity to extend the Affordable Care Act tax credits.
So here's the latest this morning. House Democrats looking to hold the party line ahead of an expected vote to end the longest U.S. government shutdown in history. House Speaker Mike Johnson signaling a vote could come as soon as this afternoon. Bloomberg's Jack Fitzpatrick joins us now for more. Jack, do you see some smooth sailing later this afternoon or some wrinkles, some rough seas ahead?
I don't see smooth sailing, but it looks like the end of the shutdown is just about here. We've got one more critical vote in the House. It's probably going to be a very close vote. The conventional wisdom that if you can get 60 votes in the Senate, you're probably fine getting a majority in the House, I think holds here. But you've heard some hard opposition from House Democratic leadership, despite the fact that this is kind of supposed to be a bipartisan deal on funding bills to end the shutdown. We'll look to the centrist Democrats to see if the Republicans can pick up a couple. Your Jared Golden from Maine, your Marie Gluesenkamp Perez from Washington, perhaps. But this is going to be close to the party line, and that puts even more pressure on Speaker Mike Johnson after being gone for almost 2 months to come up with a good solid whip count and make sure his members are in line, because they will need almost all of the Republican votes to be there to end this, send it to the president's desk, and finally be able to move on from the longest shutdown ever.
42 days and maybe 43. And possibly this goes on a little bit longer. Let's hope it doesn't. But Jack, let's run with 42. The Democratic leadership has had a 42 day commercial on their healthcare effort. How's it resonating in the court of public opinion?
You know, a lot of people were surprised because the polling generally looked pretty good for Democrats. There were a series of polls saying, who do you blame more for the shutdown happening? It leaned towards Republicans and favored politically Democrats. They put a spotlight on the issue that they wanted to spotlight with rising healthcare premiums. The Democrats definitely established they were the ones who wanted to extend the existing subsidies that are set to expire at the end of this year. That said, they couldn't hold everybody together, and now they're riding on a promise of a vote in the Senate, not in the House, in December for something that hasn't yet come together. So there's going to be frustration from the base on the Democratic side with Democratic leadership and the moderates for allowing this to happen and not actually getting anything out of this, though you at least have to give them some credit for establishing where they stand. This is going to be a big issue in the midterms, and Democrats at least have some positive polling on their side, though they, again, have some frustration from the base that expected more out of this.
Jack, thank you, sir. Jack Fitzpatrick down in Washington, D.C. We'll catch up with Jack a little bit later. So, big question for all of us tracking the markets. When do we get the economic data? The National Economic Council Director, Kevin Hassett, had this to say in the last 24 hours. I've been told that some of the surveys were never actually completed, so we'll never, perhaps, even know what happened in that month. What does that tell you about the October data?
That we're not getting CPI. Period, full stop. I mean, or if we do, it's going to be so muddy that people are going to really struggle to understand what exactly it looks like. We are going to get September jobs report. That probably will be number one, possibly early next week. After that, kind of a pot shot, whether it's retail sales, whether it's other peripheral data points that indicate inflation. But right now, it seems like we're kind of going to be in that fog for maybe forever when it comes to that 1 month period.
It's not going to be fun for the next few months. John Lieber of Eurasia Group joins us now for more. John, welcome to the programme. What's your understanding of the data we will get and won't get in the coming weeks?
Well, the BLS and the BEA are still shut down, so we don't know exactly what their plans are. I'd expect they'd probably announce something by the end of this week, or maybe Monday of next week, a timeline for when they will get these reports out. Some of them, they can collect the data. November's looking dicey right now because this is the reference week for payrolls. They could always push that back a week and collect the data next week, and then they release the November data a week later in December. That's what they've done in previous shutdowns, but we really have no precedent for anything like what we've seen here in the 2018 shutdown. The government was partially funded, so data releases weren't disrupted. And in 2013, which is the closest analog, you had a 2-week delay, and then you had some delay in other some of these reports coming out. I do think it's right. We'll just never know some of the things from October. The employer survey, we probably can get some pieces of that from October, but the household survey, I think they probably just won't release anything, and we'll be flying blind on that month.
John, give us a reality check. I'm in New York. We cover financial markets. Obviously, there's a home bias. We think this is really, really important. Is it even on the radar of people down in Washington, D.C.?
No, this is not an issue that's come up, I think, in any of the shutdown discussions. It's a distraction. You know, this is about Democrats wanted to rein in the Trump administration. It's about healthcare costs. It's about a whole bunch of other things except data. I mean, these are kind of would be in Washington would be considered extremely wonky issues, and nobody on Capitol Hill is wonking out about this stuff.
Yeah, but there is a larger takeaway here, John. And I was looking at the history of government shutdowns. There have been 6 since 1990. They're getting progressively longer. They were 2 to 3 days under Ronald Reagan and George W. Bush. Under President Clinton, it was as much as 21 days. Under President Obama, 16 days. Under President Trump, 1.0, 35 days. And now here we are at 42 plus days. I'm just wondering what this means about Congress's ability to get anything done, and whether January 30th is the next D-Day where we're going to get another government shutdown.
Yeah, I mean, I think you hit the nail on the head here. The federal budget process is fundamentally broken. It's been broken for probably a decade now. And as it kind of creaks and cracks and Washington becomes more partisan and things become harder to do, I think the brokenness of the federal budget system becomes more obvious and starts having real world consequences. Congress hasn't completed the appropriation cycle on time in years. The idea of even doing a budget for reasons other than doing a reconciliation bill is basically laughable. And I think what you're going to see is increased likelihood of shutdowns. Now, in the past, what we've seen is that nobody really wins from a shutdown. Members come out of that saying, gosh, I don't want to do that again. I'm not sure that's what you're going to see this time around, given how long everything functioned just fine under the shutdown government. I mean, a huge portion of federal workers were considered essential, meaning they could do their jobs but not get paid. And it wasn't until flight delays really started kicking in and you had this issue with SNAP benefits that people started to really feel the real world pain. But I think that one of the lessons of this shutdown is that a week or two or longer of shutting down the government really isn't that big of a deal. President Trump can fly around the globe making peace deals, tearing down the East Wing, and it doesn't affect people's lives until you get much deeper into the shutdown.
Yeah, but John, to John's point earlier, when he was talking about the fact that we may not get this data ever in terms of data that was not collected during the reference period, Greg Dako over at EY Parthenon said that about 20% of the economic hit from the government shutdown probably will be permanent, just simply because there is sort of this lost economic activity. I'm just wondering, does this change the landscape for investors, for corporations trying to maneuver in a world that is affected by a government shutdown, even if most people don't feel it?
I think that if you're thinking about the future and thinking about possibilities of what the future is going to look like, you've got to have a much wider range of outcomes on your radar and prepare for those outcomes. You could have an even longer government shutdown in January. There could be no government shutdown in January. You could have the Democrats take back the House next year, and then you get an even longer shutdown coming in 2027. So I think there's a lot of different possibilities here. You can't rule anything out. And I think that the fact is that the policymakers just aren't going to respond until their constituents are feeling pain. And right now, I mean, and it's possible that this government shutdown, everyone walks out of this and says, boy, that was more painful than we thought. And to your point, the data is that the economic pain is permanent. But I don't get the sense that's happening right now, but we'll see how people feel in a few weeks.
John, things are changing down in Washington. And can we just wrap things up by leaning on your experience? You know the Capitol well. Nancy Pelosi is stepping aside. She's retiring. Senator Schumer is under immense pressure. You worked alongside the former leader, Mitch McConnell, longtime leader of the Republican Party. What's left of Washington, D.C. that you knew so well?
Very little. I mean, I think you look at the committees on Capitol Hill, they don't do much anymore. They're not producing legislation. Lawmakers are no longer kind of growing. The senior lawmakers that are going to be running the show in the next 5 to 10 years aren't ones that grew up in this era of bipartisan compromise where they came to Washington to do legislation and get bills done. They're people that came up in an age of Donald Trump and social media. And I think that creates a different set of incentives for lawmakers. It makes lawmaking harder. Congress has abdicated a lot of its responsibilities, and the public doesn't take it very seriously. So I think on Capitol Hill, at least, you're going to get a much weaker generation of leaders, and no disrespect to the people who are there now. This is just a broader trend. And I think it means that Congress takes itself out of the governing game and puts itself into a full-time campaign mode that's going to define more and more of the noise and policymaking you're hearing out of Washington.
John Lieber. Put well. Thank you, sir. John Lieber of Eurasia Group on the latest down in Washington, D.C. I'd throw in the fact that we've just torn at the fabric of coherent ideologies over the last several years on both sides of the aisle.
Yeah, there's a real question around what government intervention should be in the business cycle, in corporations. I love how Punchbowl put it. We want to welcome back members of the House of Representatives to Capitol Hill. Remember, the big white building with the giant dome is the Capitol. That's where the House floor is. We know it's been a while because there is this feeling that there just is an actual abdication of responsibility, if not, just a virtual one.
You talked about the likes of vibes, right? Let's talk about the vibes in Washington, D.C. When you see politicians that think they're influencers and not policymakers, we've got a problem. And I hope that's not how things play out here in New York City.
Well, that's going to be an interesting point of discussion, I'm sure, at tonight's dinner with the Wall Street executives at the White House. How much can you imagine that Mamdani is going to come up in those conversations, given the fact that there's been a real tit for tat between President Trump and incoming Mayor Zoran Mamdani, and a lot of the executives in that room, if not most of them, all live in New York City.
What to watch later this evening. Coming up next, Hugh Van Steenis of Oliver Wyman saying AI investors need to pick up the slack. Plus, Danny has some of the morning movers this morning. AMD predicting a boost in earnings on AI demand. Growth ahead is looking good for that company. According to that company, that stock is up by more than 5% from New York City. You're watching Bloomberg TV. 3 days of gains on the S&P 500. Here's day 4. We're higher by 0.25% on the S&P, up by 0.5 on the Nasdaq 100. A lift on the small caps, the Russell up by 0.1. The bond market reopens with bond yields lower, trading off the back of the data out yesterday. Weaker than expected economic data almost across the board in the last 24 hours, driving yields lower by 3 basis points at the front end of the curve to 355.76. The big debate at the front end of the curve, what does the Fed do next? A range of views coming up later. Check this out for the Fed Speak today, Lisa. Williams, Paulson, Waller Bostic, Myron, Collins, and a whole lot more to come for the rest of the week.
And that will offer approximately no clarity on exactly what they'll do next month because there is a lot of division and it's unclear whether they'll have any new information or, frankly, any new consensus heading into December. A real question here around a battle between what we are in. Are we on some sort of reacceleration? Are we on a technologically imposed regime change kind of moment where suddenly we have new productivity? Or are we heading into a stagflationary type of environment where you're starting to see the data reflect that?
Some officials are worried about the labour market. Others are more concerned that inflation is closer to 3 than it is to 2. And in the next month or so, ahead of their meeting at December 10th, we will get some payrolls data, but we probably won't get some inflation data. So to convince those hawks that they need to cut interest rates, that jobs data we will see needs to be a whole lot worse than expected to convert them to cut interest rates.
And then overlay on top of this question on what's behind the labor market data that has shown a reduction in the number of jobs actually created in any given month. Is it immigration? Is it a supply side issue? Or is this truly a demand waning? And if it is demand waning, is that truly signaling some sort of recession? Or is that signaling that we're all going to be replaced by robots? I mean, I'm being sort of tongue in cheek here, but there is this element of what are we looking at? And everyone has a different opinion.
Are you having that recurring nightmare? I'm having it too.
Or, yeah, I mean,
wake up, sweating.
Yeah, it's a robot being like, hello, I am Lisa Abramowicz on television.
Just telling people about financial markets, switch up the boards and get to the bond market. No.
To be honest, sometimes when I wake up and the alarm goes off at 3:15, I'm like, you know what? The robot can fill in today.
You can have it. On your way, son. Speaking of worries about inflation, the UK getting a record £69 billion in bids for inflation-linked debt. In that sale, that number, that headline just crossed in moments ago. As we count you down to the opening bell, 3 hours away, let's get you an update on some single names, some morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John. A rebound tech-wide this morning for the chip stocks. Helping with that is what we heard from AMD, giving a new outlook, a renewed outlook, an update from Lisa Su, the CEO there, saying that revenue expectations are going to be higher, 35% gain for the next 5 years. When it comes to AI data centers, that will look more like 80%. So trying to assuage some of the fears that we've had in recent days about the sustainability of AI-driven revenue, those shares up 5%. Elsewhere, a great scoop from Ryan Golds and the deals team that the payments firm Biel Holdings is exploring a sale, according to people familiar. We don't know with who exactly. It could be another large payments provider or a private equity fund. They've been under pressure from activist investor Starboard, hence the exploration of the sale, and those shares up 12%. Finally, we got some earnings early this morning from On, the running shoe company, and it was a beat and a raise. Even though this company has the most expensive running shoes on the market, they raised prices in July. They kept them higher. There are fears about tariffs. People are still buying them. There's lots of demand. They especially saw bright spots in Asia and in Europe. So those shares up 8.7%, John.
Danny, thank you. Good news for them because the shares of Deckers have had a terrible year so far this year.
Yeah, Deckers tried to get into the running game, and frankly, On Holding has been winning it. Nike is battling to try to keep up. It's really competitive. It is highly difficult. I'm looking right now at Cloud Surfer Max for $180, flying off the shelves, and people can't get enough of them. It's not a price game anymore. It's something else. And so this, to me, is get into the running clubs and start giving out freebies.
You're a runner. I don't like those thick heels, those thick soles. I don't like them at all.
You know, it depends which ones. Some of them are very effective. Some of them aren't. It depends how bad your knees are or how good your knees are. It depends the distance that you run.
I feel like I'm on stilts, you know. I like to be low to the ground.
I like to have
Agile.
the springs, and I can just sort of spring up.
Oh, you like
up,
those? No, I don't like those at all.
Up.
I like to be low to the ground.
I can imagine that. Stealth.
Move in and out, you know, of people in New York City. Anyway, on our radar this morning, I don't run. President Donald Trump hosting Wall Street's elite for dinner this evening, including JP Morgan CEO Jamie Dimon. People familiar with the matter telling Bloomberg the president is looking to bring business leaders on board with his policies. Elsewhere, the record-breaking government shutdown is finally nearing its end on day 43. House Speaker Mike Johnson ordering lawmakers back to Washington for a possible vote later on today. And finally, AMD rising after predicting accelerating sales growth over the next 3 to 5 years, driven by surging demand for AI products. The CEO, Lisa Su, expecting data center revenue to increase by 80% and seeing the total chip market reaching $1 trillion by 2030.
Lisa Su saying at this dinner that the rate and pace of change in AI is certainly beyond anything that I've seen, talking about how profit margins are going to get to 35% as they meet both what's going on at Intel as well as compete more directly with NVIDIA. It raises a question about the vibes market, because a week before she gave this talk, there was a round kind of disapproval of the earnings that came out better than expected and the shares fell. Now she comes out giving the same kinds of projections, the same kind of vibes, and the reaction is so much different. It points to just how different and fickle the market can be on one day to the next.
Some pushback in the last week, but some relief this morning off the back of that particular forecast. Lisa Su, it's not going to level off. That's the outlook for demand. Let's turn to AI infrastructure. Investor concerns rising as big tech issues record debt to finance the AI build-out. Hugh Van Steenis of Oliver Wyman writing, financing the trillions needed for digital and energy infrastructure demands long-term capital. As the boundary of what banks can provide got moved, investors need to pick up the slack. Hugh joins us now for more. Hugh, good morning, sir.
Morning, John.
Let's just talk about that. The boundary for what the banks can provide. What does that mean? Just unpack that line for us.
So with the change in regulation, banks struggle to lend much more than 5 years. And with a lot of these data centres, they want to do 8-year money, 10-year money and lock it in. And so that provides an opportunity for both the investment-grade bond markets, but the quantity needed to fund is good. Let's say JP Morgan's forecasting $700 billion for next year. For data centres in the US alone, probably doubling by 2030. That's more than the IG market alone can hold. And one of the sources of flexible capital is private credit. And I think what's been really interesting to me, and we spoke about before, is the complexion of private credit has changed. I mean, finance has evolved in an enormous amount. Something like 2/3 of all the new money in private credit in the last 3 years have come from insurers. They want a slightly lower but more dependable return, and that's structurally lowering the cost of capital of what private credit can do. Hence why data centres is right in their ballpark.
And they'd obviously want long duration, investment-grade debt. Now, we saw some of that come to market. We saw Alphabet come to market with an 8-part offering, including a 50-year maturity. That demand came out and sucked up all that supply. Week before, it was Meta. Okay. Do you think that demand's ready to go? Can it meet this moment? Or do we need to build this market out more?
Well, I think it's both. I mean, I think you've already seen a flurry of very large deals, but it's probably in the hands of probably only 4 or 5 players at the moment. So actually, 4 players can't take all of it. And so even they are actually arranging the deals and maybe syndicating half of it away to elsewhere in the bond market. But no, I think it's ramping really, really fast. And certainly I was with one manager yesterday who said they think this private investment grade market will actually be larger than the rest of their private credit business next year in terms of growth. So it really is the key focus for 26.
How concerned are you that fundraising has been at a record pace for private asset managers in credit? They have a lot of money they need to deploy. They're looking for opportunities, and it seems like there's almost more cash chasing potential opportunities than there are the potential opportunities to get financed. That's usually a recipe for accidents. How concerned are you about that?
Lisa, I think it's a great question. I think, look, the space is now large and varied enough that it depends which piece. So I think you're right that in the leveraged finance market, as you speak about daily, the M&A market has not picked up that much, nor has IPOs. So there it's loans are heavily picked over. And actually, with the financial deregulation simplification, the banks are becoming much more relevant. So LevFin, acquisition finance, is very tightly bid. But actually, in terms of this new infrastructure build-out, the demand exceeds the supply. And so actually, it's interesting, even with the deals that John just mentioned, you can get, if it's an off-balance sheet structure, you can get about 1% more than the investment-grade index. That, for an insurer, is pretty appealing if it's a 10-year duration.
This is really largely asset-based finance, though, with the data centers in particular. And I just wonder how much we're evaluating whether we need data centers in Tennessee and the Southwest desert if this actually does get more efficient and start to build out. I mean, at what point are we talking about assets that are going to become obsolete in short order?
Oh, look, this is, again, if I think about the big debates that people are doing their year ahead and thinking about 26, this is one of them. I think the way it's been put to me is like for the next 3 years, the demand is so strong, actually, you're being underwritten by very, very high-quality borrowers. I mean, let's make a comparison here. If we were sitting here in 98, 99, and there's a little bit of that, a field that you speak about, you had Global Crossing, you had some of these large non-investment-grade firms making investments. Today, these hyperscalers they're a better credit rating than France. I mean, for the moment, and so you're seeing much higher quality borrowers. So I think there'll be some differentiation. I suspect that the hyperscalers and the really good credits, who are really good tenants, will get a slightly cheaper cost of capital. And then you'll need to be paying up for that little bit of, will the tail still be there in 5 or 10 years? And of course, these are different. You need to replace the chips every 3 to 4 years. So there's some real constant refresh capex. So look, there's nothing in finance that's simple. There's never money left on the table. This is going to be, something where you need to be smart. And I think it's that challenge between the people who are smart credit risk takers and those who are not.
There are some weak spots. Can we explore some major question marks in the ecosystem? So I'm with you. The hyperscalers, really strong balance sheets, got all that. They're the ones making these massive investments. Let's talk about OpenAI. Yeah. So they've got huge spend commitments over the next several years, which are a multiple of the revenue they're currently generating. And that really feels like it's the foundation for everything that's happening around us. Is that the big bet? Lisa's asked this a few times. Are we betting on one company?
Well, look, I probably don't speak to one particular company, but let's say our good friend Torsten Stock had a good chart showing how the scaling of OpenAI is something like 3 to 4 years faster than Nvidia and Facebook and so others were. If that were to hold, then hopefully that's the case. If they then slip back to the same trajectory as the others, then of course the financing needs start to become much more challenging. But look, it's a great question. I think that there's a lot of thoughtful credit work being done to try and think through what are the vendor financing or what's the control place here.
Do you think we're at this point already where we're starting to test investor tolerance, where they need to demonstrate exponential revenue growth from here to justify some of the spend commitments we've seen?
Certainly, the way it's being put to me is that the investor conversation we have is that they need to maintain this extraordinary fast scaling, otherwise things will slip.
Right now, I'm just wondering, going forward, whether you think that energy constraints are going to become an issue in the near term. I mean, how much some of the data center build out is really going to be contingent on how quickly the grid can keep up?
Oh, completely. So this is So Lisa, this is why I think also in the conversations we're having, we're now starting to say, like, the difference between is the data center next to existing grid connections or existing, maybe it's an old coal-fired power plant which needs to be repurposed. That's getting a cheaper cost of capital, the ones which are off. So no, these the interconnections and the energy demand is becoming not only a political issue, but also one which is really at the heart of economics. Now, look, I'm not saying every deal is correctly priced, because there's such a frenzy here to do the build-out, but I think there's much more focus in the due diligence now around where's the energy coming from. And the other piece is, given the demand, there's probably going to be huge inflation in actually putting these together. So I'm also hearing people underwriting saying, you know what, let's assume not only the price, but a bit like in the pandemic, plus some. And obviously there's a debate about what that plus sum should be.
Hugh, given the constraints, to Lisa's point, could come from energy, is there more comfort in the investor world to support that build-out than maybe there is elsewhere in the broader story of AI and the data center effort?
I'm not sure I've got a strong view on that, John. I mean, I think that I can see what the spreads are tight enough to suggest the demand is definitely there. But I think it's, look, these are tough questions going to 26.
The worry is overcapacity, right? Yeah. Overcapacity in one thing, but the story seems to be that we don't have the capacity and energy. And I would have thought that people would develop more comfort in that story, at least allocating capital to it, because that's what we need to develop. So maybe some of the questions that remain elsewhere about the other things.
But isn't that why some of the biggest deals we've seen in the last few months are not just data centres, they're actually LNG, pipes, grids, it's also the utilities. And I think that's interesting. Some of our private credit clients are spending as much time around utilities and energy as they are on pure data centres for exactly your reason.
Well, data centers are more satisfying, John. I mean, right now, the idea of investing in something that's going to take 10 years to build out, not something a lot of people want to get around to.
Yeah, data centers are also very controversial.
That's
of course,
true,
because
100%.
of the energy costs that come with that to the community that they put those massive things in. And they are huge. They are some ugly things, right?
How much do you expect a lot of the big tech giants to become utilities? In 10 years, they're going to be the ones that have to build this. They're going to be the ones that regulate this. They're going to be the one that's financed this. Because ultimately, you're right, it is a political issue. And at a certain point, after they get the exponential growth, if we all rely on them to that degree, how much does their profit line look more like a Verizon than it does, say, the Metas and OpenAIs of today?
This is how I think about things. I'll use my hands. Profit growth's up here. Employment growth is right here. And in between is a lot of space for societal pushback and political tension. All of that right there is where the game's going to be played over the next 18 months.
Yeah, watch the space. So given the fact that Congress seems to be on the ball and very much ready to legislate compared to the conversation that we just had with John Lieber, I'm looking forward to their propositions for exactly how to narrow the space in a productive way.
Hugh, it's good to see you.
Thanks very much for being here.
Thanks for being here. Thank you, sir. Hugh Van Steenis there of Oliver Wyman. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahira Arnott. Hey, Yahira.
Hi, John. Speaking of the AI build-out, CoreWeave shares are staging a modest rebound, up about 1% after a 16% drop in yesterday's session. In its latest earnings results, it announced it expects a delay in fulfilling a customer contract caused by a third-party data center developer being behind schedule. That caused it to trim its outlook. Shares had more than doubled this year after its initial public offering back in March. Meanwhile, leaders of major U.S. airlines pressed for more information on the safety data that justified the flight cuts mandated by the government due to the shutdown. People familiar say executives asked the FAA if the agency identified risks that the carriers might not have been aware of. The FAA shot down concerns and went ahead with its plan to cut 10% of flights across 40 major airports. And JP Morgan is broadening its push into the digital asset space. The world's largest bank has started rolling out a deposit token called JPM Coin to institutional clients after a months-long trial. The coin allows users to send and receive money via the Coinbase-affiliated public blockchain base, allowing payments to process in seconds and 24/7 rather than in days and just during working hours. That's your Bloomberg Brief. John.
Yahira, thank you. More from Yahira in the next hour. Up next, getting the data back on track.
We hope that with the government reopening, we can get very quickly October and November employment data. Right now, we just have to go ahead and interpret this data because this is all that we have.
Up next, we'll catch up with Jane Foley of Rabobank, live from New York City this morning. Good morning to you all. You're watching Bloomberg TV. Your favourite 24 hours full of Fed speak coming right up. John Williams of the New York Fed, Philadelphia Fed President Anna Paulson, Chris Waller, Fed Governor, Stephen Myron, Fed Governor, Boston Fed President Susan Collins, and more over the next 48 hours into the weekend.
What clarity can we glean from this, John? What do you think we're going to learn? How much can you really get a sense of what they're going to do in December and beyond? What's your view?
Very little.
All right. But
I will say, I think we can stress test their positions and say to them, if we don't have inflation and you don't get a CPI report by the December meeting, does it make the call to cut interest rates or hold harder, easier? You tell me.
Yeah, what data are they looking at? What's actually going to be the tell for them, especially given the fact that it's unclear which government data we're going to be getting? And that, I think, is a really key question for a lot of them out there.
Under surveillance this morning, getting the data back on track.
The October data is going to be very noisy and it's going to be affected by the government shutdown. This coming month is going to be pretty tough. We hope that with the government reopening, we can get very quickly October and November employment data. Right now, we just have to go ahead and interpret this data because this is all that we have.
So here's the latest this morning. Investors are waiting signs government data will resume, with alternative data sending mixed signals on the economy. Jane Foley of Rabobank writing the dollar will be more sensitive to poor data releases in the coming weeks than to good. Either way, it's time to reassess the outlook for the greenback. Jane joins us now for more. Jane, welcome to the programme. What data are you focused on?
You know what, any data, I think at this point, but particularly, of course, the labour data and the CPI data, if and when we get it. But, we all know that that's going to be pretty confusing, perhaps, and in October it will be affected by those shutdowns. But I think we learned something, particularly yesterday, about positioning for the US dollar, and that is probably going to tell us how the dollar is going to react. Because when that ADP data came out yesterday, the dollar sold off perhaps more aggressively than I thought it would on that data. And that, I think, tells us that the market isn't quite so short of the dollar anymore. And we've got to remember that whilst the dollar remains the worst performing G10 currency in the year to date, actually it's done pretty well in the second half of the year to date. And yesterday, after that data it was a Norwegian krone that was the best performer. But, last week it was the dollar that was the best performing G10 currency in the in the second half of the year to date. And now I think we're in this more balanced position for the dollar. And that, I think, is going to be crucial going into these data numbers.
In your words, it's time to reassess the outlook for the greenback. Jane, against what? Is it against the single currency, the euro, or the story of the moment, the Japanese yen?
I think all of these, but I think the yen has got its perhaps bigger fundamentals. We saw what seemed to be a little bit more verbal intervention by the new finance minister in the Japanese parliament this morning, a little bit more pushback. She appears to be becoming more uncomfortable with the yen. And actually, we had some indications out earlier in the week from the Bank of Japan with respect to their previous policy meeting. We can't write off the risk of a December interest rate hike from the Bank of Japan. That is still going to be, very much so a live meeting. So, there is the possibility that we do get maybe an interest rate hike, that we may even get intervention. I think the market is going to be wary about 155 on dollar yen. So there is very much a yen story going on there. As very much there is a cable story, a sterling story going on. But, the common denominator here is the dollar, and it doesn't seem to have an awful lot of strong direction right now.
There is a strong direction possibly later this month when we get NVIDIA earnings. How much does the AI trade really favor the strength of the dollar and kind of buoy it from losing too much value versus its peers?
I think this is really important because, for instance, if we look longer term, if we look at the amount of portfolio flows that came into the US assets, into the stock market, but also bonds, also the dollar, say from the global financial crisis up until, last year, what was driving this? And what was driving it was the outperformance of the US on growth and productivity. And of course, crucial to that outperformance of productivity has been the US tech companies. The fact that, the most of the world's biggest 100 tech companies are US based, that they're from the US, they are American companies, they're still there. And yet we had the dollar selling off at the start of the year, but I think that was more like a really big, heavy lump of profit taking after years of the Buy America trade. And if we look at US fundamentals now, maybe we're not going to be, so focused on the US trade. Maybe there is room for diversification, but those fundamentals are still very much there, and they are linked to productivity gains. They are linked, therefore, to tech. And I think they are going to, protect the outlook for the US economy and therefore for the outlook for US assets and the outlook for the US dollar going forward. I don't think we have moved into this era where the dollar's going to be on the back foot, like, many commentators were fearing at the start of the year.
Part of it is what they're up against. And I just want to conclude by asking you about the pound, because we've heard a lot of the discussion around what the budget has looked like. Is there anything that can get the pound stronger at this point without maybe regime change at the top?
Well, even if we were to get regime change, there's an awful lot of uncertainty that would have to come first. It's not that easy to oust the leader of the Labour Party. And actually, what would that do for investors? It would just add to the confusion. It would add to the uncertainty and probably be a drag on investment growth and the possibility of an uptick in productivity. So even that, at this point, I think could be a weight on the pound. So, cable has been, quite resilient in the last couple of weeks or so, but I do think we are going to see a little bit more downside on cable. I think that's got to come, and I don't really think the budget's going to bring an awful lot of good news. We just know we're going to have an awful lot of tax hikes and downgrades to growth and productivity forecasts.
I'm not sure the bar could get any lower for that budget, Jane. It's good to see you, as always. Jane Foley of Rabobank. It feels like we've had months and months of leaks about this tax hike, that tax hike. I'd be surprised if they announced a tax hike we haven't already heard of.
Yeah, and if they have, congratulations. Gita Gopinath had a great column in the Financial Times talking about how fiscal instability and uncertainty is causing a lot of the problems.
Game of Thrones over at Westminster today. We'll avoid some of that. Coming up on the programme, we'll catch up with Rieder of BlackRock, David Tinsley of the Bank of America Institute, and Amy Gower of Morgan Stanley. The second hour of Bloomberg Surveillance up next.
both businesses and consumers are wary about the economy.
Without data, it's kind of hard to get a gut check.
The October data is going to be very noisy and it's going to be affected by the government shutdown.
Further inflationary pressures may be coming down the pipeline.
It's a K-shaped market economy. It's a K-shaped socioeconomic recovery post-COVID. Everything is diverging.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures adding some weight to the rally. 3 days of gains on the S&P 500. Hello, day 4. Higher by 0.2% on the S&P. On the Nasdaq, up by 0.3%. In the bond market, a rally this morning. The Treasury market reopens after some weak data yesterday. Yields are lower by 3 basis points at the front end of the curve on twos, 355.76. Today, we can debate the front end of the curve, a big debate at the Federal Reserve, and a ton of Fed speak through the next 24 hours.
A real lack of clarity around what the Fed's response mechanism really is at a time where people can't understand whether we're heading into a reacceleration or whether we're heading into a downturn, whether we're heading into a surge in productivity or whether we're heading into something that feels stagflationary and unsustainable with the division between the wealthy and the poor. And right now, the lack of understanding is clouding the fact that we're not even getting data, right? So we can't even get any concrete bona fide data from the government to really parse over. So people are just using the data points that are conflicting within different sectors of companies that are trying to get an upper hand. It is a stew, and Fed officials are just mired in it.
We've been leaning on third-tier and fourth-tier economic data. Challenger job cuts have been in focus over the last week or so. We never talk about challenger job cuts, and you're unlikely to get the CPI data in the next month as well, according to this line from Kevin Hassett, the NEC director, saying, I've been told that some of the surveys were never actually completed, so we'll never perhaps even know what happened in that month.
So CPI is probably the casualty that a lot of people are expecting. When you take a step back, even if we were to get the data, unclear how much of a signal we actually could get. Because right now you have the challenger job cut announcements that largely were tied to Amazon and UPS, which were announced, and Amazon linked it to artificial intelligence and the idea that they are doing more with less, fewer people. But there is this larger question about the fact that companies sound pretty good. They're not talking about recession. They're not talking about downturn, but they're not hiring. So how do you solve that puzzle? Is this a puzzle that is solvable with more layoffs, or is this a puzzle that is solved with more productivity, greater economic activity, and then eventually more hiring?
We'll get into that puzzle in just a moment. Coming up this hour, we'll catch up with Rieder of BlackRock. With equities looking to stage a comeback, David Tinsley of the Bank of America Institute as consumer spending continues to climb, and Amy Gower of Morgan Stanley as the AI build-out pushes copper even higher. We begin this hour with stocks hovering near record highs. Rieder is BlackRock's CIO of Global Fixed Income and is widely considered to be one of 5 contenders to replace Fed Chair Jay Powell. He writes the following: moving interest rates lower is very much in line with what we do know today, which is that the labour market is clearly slowing to the point of potential stall speed. Rick joins us now for more. Rick, good morning.
Thanks for having me.
It's good to see you, my friend. It's been too long.
Thank you.
Welcome to the studio. Have we got a labour market problem?
I do. I don't. And by the way, I don't think it's a cyclical phenomenon. I think there is, or the way Lisa was, I think we have a productivity revolution that is pretty extraordinary. People point to AI as an exclusive driver of that. If you look across what companies are doing, including second quarter earnings, third quarter earnings, if you look at the dynamic around how you think about logistics, freight management, predictive maintenance, customer procurement, companies are doing more with less, and I think that is a secular dynamic that's going to be with us for a couple of years now. I mean, we can talk about there's a bit of elevated inflation because of tariffs, but I think we're going to be dealing with something. By the way, you also put robotics, automation. This to me is a structural dynamic. I think full employment will be the challenge for the next couple of years.
So we mentioned the spread between earnings growth, fantastic, employment growth, terrible. How are we closing that gap, if ever?
So I think, by the way, I actually think that's not a coincidence. Those aren't coincident factors. What's happening is companies literally, the top line revenue is pretty good generally, but what's happening is they're cutting costs of goods sold, they're cutting their SG&A costs, they're reducing their cost infrastructure. By the way, AI is a technology. There's historically been this dynamic of when you have new technology, it moves people into other higher value jobs. This technology, by the way, I put robotics and automation on top of it, autonomous driving, et cetera, is literally designed to replace human input. You have a dynamic that is pretty extraordinary that I think, if, as a central banker or whatever, as you think about being anticipatory of where the world is going, that is where the world is going, and I think that is a challenge. Economy's doing fine, divergent. and quite frankly, only operating on a couple of cylinders. Huge CapEx, which we talk about from cloud, from infrastructure, from power. And you've got higher income, wealthy savers that are doing great and supporting consumption in the economy. And then you have the part of the economy that's interest rate sensitive, that's really struggling. And that's part of why the interest rate tool needs to address low income, small business, housing. And that's where I think you square the circle.
So we've got to talk about this from two perspectives. One as a policymaker, the other as an investor, and one, of course, informs the other. Let's just sit on policy for a moment. You're talking about maybe the need to cut interest rates, but also the fact that some of the pullback we've seen in hiring is not cyclical. How can we address one with lower interest rates? Just explore that for us a little bit more.
Yeah, so first of all, if you came down from Mars and said, okay, so I've got 5-year inflation break-evens that trade in the market, you buy as many as you want at 2.35%. And you said, okay, now set the price. And you said, okay, 2.35% inflation, and I clearly have a slowing labor market. You would say, gosh, I don't know if I set the rate at 3, and then I thought about, okay, so now what's equilibrium on the mortgage rate to create velocity in housing? And it's directly related to what you said. Housing today is 3/4 of the wealth by people in the country is in housing. We have a housing market that, you look at the earnings from D.R. Horton, you look at Lennar. By the way, I just saw an ISI home builder survey that showed the softness. If you actually get the mortgage rate down a bit, then what happens is all of a sudden you get housing velocity. Why is housing velocity important? Because you get labor mobility. Today you can't move. You lose your job, you got to go somewhere else, you can't move. Secondly, and I've said it before, for every home built in this country, we hire 3.1 people. It's pretty hard to AI building a house. So if you can get some real estate velocity, and by the way, it's the way young people who are struggling today, young people who aren't savers, who are borrowers, that's the way they build wealth. That's the way you put people to work. And so I think it is all a related concept. Point being is, and by the way, I mean, if we had to raise interest rates to where they were, but if you said to me today, what's equilibrium? I don't think it's where we sit today in the funds rate.
So how willing are you to allow, or how willing would you be to allow inflation to run above that 2% target in order to run the economy hot to allow for more job creation?
Listen, it's a great question. And I think every time you think about these things, and I think about the same thing, we take risk. You sort of think about what are the quadrants of risk? What are you willing to underwrite? So today, when I think about those quadrants, if you were willing to take some labor and some overall inflation, then you think about, okay, what are the sticky drivers of inflation today? Healthcare, education, insurance. It's pretty hard using the interest rate tool to get insurance costs down. It's pretty hard to get a healthcare. So the tool is not that robust. And health shelter is a sticky part of inflation. That, if I actually get the rate down, I'll actually mitigate some of that elevated. I'll mitigate the rental inflation. So, I'll throw one other thing. 5-year inflation expectations are 2.35%. If you were at 2 3/4, and by the way, core PCE, the 6-month moving average core PCE is 2.5. Let's say we're probably closer to 3 if you take the whole full construct of inflation. 3 is not an infectious, you clearly don't see it in terms of where people anticipate inflation. If you're running 4 or 5, then I'd say, gosh. Or if the 3 was trending higher on things that the interest rate tool impacted, then I think you'd have to address that.
Just to sort of build on that, and this idea that 3 is okay, but above that, maybe not so much. There's a feeler that there is an asymmetry in the time frame of AI. That right now the build out is going to be inflationary because of the inflationary inputs of commodity costs, of just how much lending and money this is generating on a broad scale. The productivity gains that will cause disinflation will take a lot longer to come into play. So how, if you were the head of the Fed, would you handle that?
So I take a thing. So think about historically the way the interest rate tool worked is it was a modulator of CapEx. So you think about, go back 60s and 70s, the big spenders in manufacturing. Today, my guess is OpenAI, NVIDIA, Google, et cetera, it's not the interest rate tool that is affecting CapEx. They are going to put that CapEx in because there is a long run benefit for doing it, meaning the interest rate tool doesn't really do a lot. So I think at the end of the day, does that create a little bit of inflation in the areas you described? I think so. But I think you have to say, where are we going? And I will say, being an investor for a long time, the concept of data dependence, if you were constantly in the rearview mirror trying to figure out how would you invest, it's probably the wrong way to do it. We are going through something that's very different. We now are in a CapEx cycle. And then if you break down the economy and say, okay, what is driving GDP today? That's what's driving this CapEx and some consumption from higher income people.
The key piece of the inflation story, shelter. You touched on it. And you said something interesting. Interest rates down, shelter costs down. Just explain that for us.
Yeah, so we have an inventory problem in the country. And by the way, you look at every piece of data, it shows the same thing. And so, by the way, when the mortgage rate has come down a bit post this recent Fed drop in interest rates, all of a sudden you're seeing existing home sales pick up. We just saw the prepayment report for mortgages, and all of a sudden you're seeing some acceleration. Meaning you don't have to get the interest rate tool down that much. If you got the mortgage rate into the fives, I'd say mid to high fives, you would see some velocity of housing. If you saw velocity of housing today, if you saw on D.R. Horton's numbers, they talked about they're doing 1% first year mortgage, and then I think it's 4.9 because they've got to subsidize the mortgage. Well, what if D.R. Horton didn't have to do that? And what if the actual organically the rate was lower? They'd build more houses, you'd create more inventory. You create more inventory, you take the pressure off of rental rates, and you start to bring inflation down. Plus the labor mobility, that is not an insignificant part of that.
Do you think the Fed needs to think outside of the box beyond just interest rates? Is there something else we can do here?
Yeah, I think the Fed has a series of tools. The interest rate tool, by the way, today, nobody really borrows off the overnight funding rate. The interest rate tool, it used to be, you think about how banks borrowed short, they lent long, we had a very different dynamic. Today, the way we tranche the debt in the economy, think about how we finance resi, commercial, asset-backed credit cards, auto loans, it's tranched. The front end of the yield curve doesn't really do a lot. How you think about, where is the 10-year point? How do you think about your balance sheet? How do you think about all the other tools that are at your disposal? I think are really important. Plus, you got to think about what is the effect of the currency, et cetera, relative to that. So anyway, I think the construct is much more complex and much more, quite frankly, you have a lot of tools that create much more effectiveness, and we're just going to move the overnight funds rate every 6 weeks.
Like the balance sheet. How much would you be open to see the Fed use the balance sheet a little bit more?
So I think the construct of the balance sheet is important. So I think people don't realize there's a notional dynamic and there's a DV01, there's a duration dynamic further out the yield curve. I am sympathetic to should we keep the balance sheet around the same level, but you could be really effective. So today, the U.S. Treasury, 89% of what the U.S. Treasury finances is at the 0 to 2 year point. 89. Think about if you're a company, would you ever finance in the 1 year? It's crazy, but that's where we are today, and it is what it is. So there's not that much float actually longer on the curve. There's a reason why people put on steepeners and they get squeezed out of steepeners because there's not that much float. You don't have to use that much balance sheet, but if you thought about, gosh, the construct of the balance sheet, if we used more of it further out the curve, we let runoff happen on the front. If you can keep the stability of the back end, so if you can keep the 10-year, we got to the 10-year was 390. If the 10-year was 3.5 to 4, stable, and rate volatility came down, all of a sudden you'd see mortgage spreads could come in, then you'd get, and by the way, deregulation of the banking system, then you get mortgage velocity moving. So, by the way, I don't think we're that far away. And by the way, this concept of, we have to get the rate down hundreds of basis points. I just think we're not that far away. Just get it there, keep volatility of the rate market at a stable level, and then you'll see a system that'll operate pretty well.
Rieder of BlackRock is going to be sticking with us to talk about the market implications of some of this and the opportunities out there at the moment. Before we get there, let's get you an update on stories worldwide with your Bloomberg brief. Let's cross over to Yahara Arnold. Hey, Yahara.
Hi, John. The House of Representatives is set to vote on reopening the government after the longest shutdown in U.S. history. The short-term funding bill was reached after senators agreed to compromise on a plan that will fund the government through the end of January. The measure would reinstate federal workers fired during the shutdown and guarantee back pay for furloughed employees. Meanwhile, the U.S. military may build a temporary base near the Gaza Strip. Sources telling us here at Bloomberg, the base would be capable of housing 10,000 international troops for 1 year to monitor a fragile truce between Israel and Hamas. This as the U.S. has been seeking international support to send troops to the region to support the ceasefire. And the grandson of President John F. Kennedy is running for Congress. Jack Schlossberg says he'll make a bid for the New York seat being vacated by Jerry Nadler, joining a crowded Democratic primary. Schlossberg is an author known for his political commentary on social media. He told the New York Times that the Democratic Party needs more voices to push back on President Trump's policies. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next, Calling Wall Street.
The stock market has hit many record highs during the last 9 months, many. And it will again. This is just the beginning. We've never had anything like this as a boom.
Very close to all-time highs this morning. That conversation continues with Rieder of BlackRock, live from New York City this morning. Good morning. Stocks are positive this morning, up by a third of 1% on the S&P, up by 0.5 on the Nasdaq 100. Under surveillance this morning, calling Wall Street.
We must get the government back open soon, and really immediately. We have to get it up. We have the hottest economy we've ever had, and it's affecting the stock market now a little bit. But the stock market has hit many record highs during the last 9 months, many. And it will again. This is just the beginning, because when these plants that are being built right now start opening up, we've never had anything like this as a boom.
So here's the latest this morning. President Donald Trump is hosting Wall Street's top leaders for dinner at the White House. Sources telling us here at Bloomberg that JP Morgan's Jamie Dimon and Goldman's David Solomon are expected to attend. Bloomberg's Jack Fitzpatrick is tracking the story. Jack, what's the objective of tonight's dinner?
So there's no listed objective, but there's a broader context to consider here that the president hinted at in those remarks. This is a president who put a huge amount of political capital into getting his signature tax bill extended, and yet he sees major concerns among the electorate on affordability, on jobs. There was some pressure on him to the degree that he focused on foreign policy, taking his trip to Asia during the government shutdown. This is a president who clearly feels some pressure to refocus on the economy as much as possible and sell voters on the economy, on the tax cuts they've gotten, and on any success he can. So there's not an official agenda for what he's trying to accomplish, but he's certainly brought forth some high-profile names as you see him shift his focus a little bit away from the recent attention on foreign policy and back to the economy as his bread and butter as we get closer to the midterms next year, especially.
We'll see if we can get the cameras in there as well, Jack, a little bit later this evening. Jack Fitzpatrick there of Bloomberg down in Washington, D.C. Still with us, BlackRock's CIO of Global Fixed Income, Rick Rieder, also the head of the BlackRock Global Allocation team. Rick, you've seen a lot going back to the late 80s. How much fun are you having right now?
I've said before, this is the best investment environment I've ever seen. I mean, not because stocks are going to go straight up. I mean, you have divergence that is great for investing. You have technology that's changing, and so the ability to look at tech stocks, healthcare tech, to look at, where some of the financials, how you create velocity in the system. And then, the earlier conversation, we were talking about the break. Like now, the income levels, as long as this interest rate stays here, what's ironic is commercially, I'd prefer the interest rate to stay here because this is pretty good. We can create portfolios. We run this ETF called Bink. And, creating 6.25, we're running almost 630 now. You don't have to take a lot of risk. You don't have to go out the yield curve. That's pretty good. So anyway, I think, and by the way, the options market, I think the best opportunities are in the options market. Rate options, equity options, and you can manage your convexity. So you can be long equities and then buy a lot of, you can overwrite your single name stocks. You can buy downside. It's a fun environment.
Well, let's lean into Bink. You mentioned it, the iShares Flexible Active Income ETF. What kind of things have you been doing over the past 6 months?
We've been, the cool thing about being active is you can move around because the regime shifts. And while, I was describing earlier, like, where do you think the interest rate should be? The truth is the interest rate isn't going to move very far. So, we're keeping our interest rate duration, in and around 4 years. We've moved a little bit out of the very front end because it's pricing a lot now in terms of where this Fed is going to go. Then we've shifted some of our credit into mortgages. Quite frankly, if you believe rate volatility is going to be down, mortgages have become interesting, and credit spreads have gotten pretty tight, particularly U.S. investment grade has gotten pretty tight. So we've rotated out of that. We've bought a little bit of EM recently. I would say recently over the last 6 months. We haven't bought EM in a long time. If you believe the dollar is contained, EM becomes pretty interesting. And the yields, relative to high yield, the yields in EM are attractive. So we've cut a little bit of high yield. We've got a good amount of investment grade credit, and we've rotated. So today, I think our average rating is A-, which is pretty good. So it gives us a little bit of room to do some things like EM.
You said something that was interesting there, which is you don't have to go very far out the risk curve in order to get income now because yields are high. If the Fed were to cut rates, does that make you more inclined to take more risk?
Yeah, I mean, I have to say, for two decades, part of why I'm so excited about where we are today, for 2 decades, it was like, I got to buy high yield at 3.5 and 4, and it doesn't feel natural. But now, if you have the risk-free rate, particularly in the front end here, gosh, I put a little bit of spread on it. Now I get what is ample yield with default rates that are not that elevated. You are seeing some bubbling defaults in a couple of places. So, I think the thing that we would do is, I know what we would do is if rates come down, I'm not a believer, and this is what blows you up. I'm not a believer is, gosh, I got to keep that yield. I got to get my risk up. You just have to absorb it and say, you know what, I'm going to run. I can't run 6.25 or so. I'm going to run 5 3/4 to 6. But what'll happen is the cash rate will come down, and people say, gosh, you know what, cash is only getting me 2.5 to 3. And inflation, even if inflation's 3, it's still pretty good.
Okay. Very few people on Wall Street, though, are saying, you know what, I can just live with less income. It's okay. I won't stretch too far. I'll be disciplined, and maybe I'll just take less cash and I'll commit to the economy. At what point can you imagine that things start to get a bit excessive, especially given the fact that there is a lot of cash right now looking for a home?
So, by the way, it's a funny thing as you say that. We live in a competitive environment. We can't just sit back. I mean, it is a tough business, and we have competitors and people that are out there say, gosh, I can get you more yield. Listen, I think one of the things you have to do is you got to keep your volatility. As long as you always think about what's your yield per unit of volatility. Today, I think equities are still going up 15 to 20% from where they are over the next year. So I'm just trying to keep our volatility at a reasonable place. What is excessive? There's some things that are bubbling in the markets that are mostly in privates that are, gosh, I don't get any cash flow for 2 or 3 years. What's the multiple you put on that? That stuff is hard. There are some really good business models. You say, I see it, and it's almost definitional. You see some parts of it where people have stretched, and in some of the credit markets where some of the levels get aggressive. Part of why we've rotated some of the investment grade. It doesn't do that much for us anymore at those spread levels. But I don't see, like, saw before the financial crisis, excessive low covenant or easy covenants, high LTV financing. I don't see that yet today. Around the edges a little bit, but not really.
15 to 20% on stocks.
Yeah.
Another double-digit year.
Jonathan, I think we're living through history because what you asked about before, because productivity and ROE is so spectacular. And by the way, I don't think it's 500 stocks. I think it's, by the way, we heard a stat yesterday. If you take the S&P 1500, is this right that I heard it was 22% off the highs? I thought that number, Russ Koster, to work with, I thought that was extraordinary. If you take the highest ROE businesses, let's say it's 30 stocks, 50 stocks, tech, healthcare tech, some of the financials, they're doing really well. They throw off a lot of earnings. Their ROE is high, and they buy back huge amounts of stock. Small cap, don't really know. But there's enough stocks with enough market cap that I think will get you that sort of return.
Stay with market weight on the S&P 500.
No,
embrace
we're long.
The concentration.
We're long. We've reduced a little bit of beta. When equity volatility picks up, I have to bring my beta down a little bit, but I'm still running long. And days like yesterday, single name, we get these earnings reports, and single name vol is high because if a company doesn't hit these excessive numbers, they hit the stock.
Yeah.
So you can still do some things to protect some downside. And by the way, interest rates. If you believe the Fed is moving, albeit deliberately, interest rates actually act as a reasonable hedge again. So there's some correlation to rate that's allowed us to run a moderate long.
Rick, it's good to see you.
Thanks for having me on.
Come back soon. We appreciate it, sir, and best of luck with the process. I've known you a long time. BlackRock wins either way.
Oh, thank you, sir.
The country wins either way. Thank you, sir. BlackRock's Rick Rieder. Coming up on the programme, David Tinsley of the Bank of America Institute with a consumer spending surge. Plus, Danny has your morning movers. AMD shares soaring on the back of promising comments from the CEO. Lisa Su, their stock is higher by almost 6%. Rick Rieder of BlackRock with the programme just moments ago, talking up the potential for another double-digit year on the S&P 500 and US equities over the next 12 months. Equity futures this morning higher by 0.4% on the S&P, on the Nasdaq up by 0.6% in the bond market. The bond market reopens, bond yields are lower, anticipated off the back of some weaker data yesterday. We're down by 4 basis points to the front end of the curve, 355 on 10s, just north of 4%. Rick also talking up the prospect of maybe the Fed using balance sheet to address some of the issues at the longer end of the curve.
Talking about a sweet spot between 350 and 4 for 10-year yields, that if you could kind of create that kind of level and low volatility, you could get the housing market back in force. A real question here, what is monetary policy's role if you do believe that we are living through history with respect to a technological shift that could potentially be inflationary up front, but disinflationary long term and leave a lot of people out of work? It is a quagmire, and frankly, that's what a lot of people are wrestling with.
We've talked about this a million times, the spread between earnings growth and employment growth and the tension it's generating in between. It's a problem, not for the future. It's a problem right now.
And so if the Fed tries to cap rates to keep the economy hot, to allow people to get more work, what does that mean for the dollar? What does that mean for the credibility of Fed policy with respect to inflation? These are going to be the 2026 issues that are going to really create the contours for a lot of market activity.
Conclusion, another double-digit year on the S&P 500
and probably
if
lower
rates in
rates.
that direction. Equity futures this morning up by 0.4% with some morning movers this morning. Let's cross over to Danny for more. Hey, Danny.
Hey, John. The big mover of the morning is AMD, with Lisa Su, the CEO, giving an update on where she sees the revenue trajectory and its 35% growth over the next 3 to 5 years. For the entirety of the business, for data centers, it's an 80% growth. That confidence helping to lift shares 5.6% this morning. Elsewhere, we also have a little bit of earnings. This coming from the stablecoin issuer Circle. It was better than expected, and the amount of their stablecoin in circulation doubled. The issue is for this company that has had a huge run-up, prices doubling since their IPO in the summer, is that the rate of return was lower. And again, given that big ramp up, we're seeing the reaction in shares. Those shares falling by about 5.6%. Finally, some sell-side action for you. Kava and Sweetgreen getting put on Citi's 90-day watch list. Their earnings in recent weeks flagged some real weakness, especially with the younger consumer, but Citi pointing out that they get a good chunk of their sales from the D.C. area. The DMV area, D.C., Maryland, Virginia, sees about 16% of sales for Kava, 11% of Sweetgreen. So they say the government reopening could give a boost to both those companies, John.
A reopening trade. Danny, thank you. Appreciate it. More from Danny in about an hour from now. On our radar this morning, aides to President Donald Trump considering cuts to New York City's federal funding after Zohran Mamdani's victory in the mayoral race. It's not yet clear what programs could be impacted. Mamdani saying he's ready to work with the White House. Elsewhere, President Trump hosting financial executives for dinner at the White House tonight. Attendees including JP Morgan's CEO, Jamie Dimon, Nasdaq's Adena Friedman, and David Solomon of Goldman Sachs. The president is looking to shore up support for his economic policies. And finally, aviation leaders saying flight schedules won't immediately bounce back after the government reopens, adding residual effects will be felt for days. The Transportation Secretary, Sean Duffy, offering no timeline for when flight restrictions might end.
You know, Sean Duffy has been the poster child of this entire shutdown over the past couple of weeks, at least trying to, articulate some of the concern and, frankly, some of the frustration that people feel. There was something like 10% of flights on Saturday that were canceled, and it really is isolated to a lot of the biggest airports. So you start to wonder, at what point are we looking at a disruption that can go into Thanksgiving? Right now, even if we were going to get a reopening today, it will take time. Think about the logistics. Think about pilots that have to get from one place to another. This is a logistical nightmare. Nonetheless, at some point, you can imagine things might get back to some speed.
I'll be watching a conversation you're having a little bit later. Ed Bastian of Delta catching up with Bramo around noon, about noon, 12:10?
Yeah, it'll be aired around noon.
Looking forward to that. What's going to be the focus of that conversation?
Well, I want to understand how big the parameters are for their fourth quarter and what the track rate really is, how much people are delaying some of the reservations for Thanksgiving, for the holiday period because of these disruptions, and whether this is truly an economic disruption that will lead them with a lower projection for the fourth quarter. But going forward, it also really is the perfect example of the bifurcation in the economy that we have seen. And what we have seen is that the wealthier, well-heeled travelers are doing just fine and are supporting the growth and the profitability of the likes of Delta. Is it a sustainable model, or does something have to give?
I've called it the Delta Airlines economy. It truly is. The man of the moment coming up a little bit later at noon Eastern time, catching up with Lisa. Look out for this. Ed Bastian, the Delta CEO. Let's turn to the consumer. Bank of America Institute's latest consumer checkpoint report showing a fifth consecutive month of spending increases, but noting consumers are spending more on retail but getting less, while possibly trading down in services. David Tinsley of the Bank of America Institute joins us now for more. David, welcome back to the programme. Always good to catch up. So we've seen this tension and stress with the lower income consumer for a while. Is it migrating up to other income groups?
Actually, there's not too many signs of that, to be honest. So we've got the kind of K-shape, if you like, in our data. Consumer spending, top third of the population by income, growing at 2.7% year on year in October. Bottom third down at 0.7% year on year. So we've got that, but the middle is in the middle. So if anything, slightly closer to the top. So that would be a concern, because obviously you can kind of run the economy with weakness at the low end, just because the kind of contribution to the overall consumption picture isn't great. Not talking obviously about all the socioeconomic implications of that. But if the middle went, that would be more concerning.
David, you track this, I know. What percentage of this country does live paycheck to paycheck across income groups? What does that look like at the moment?
Well, you know, we've just published on that this week, and we found around a quarter, give or take, of people live paycheck to paycheck. So literally, you know, in our definition, they have a very small margin of money left over at the end of the month after just spending on necessities. Now, the good news is that has risen a little bit between 25 and 24, but the increase is slowed down relative to the previous years. So it's not getting worse at an accelerating pace, but at the lower end, household income end, it's higher. It's about 27, 28% from memory.
David, one of the big mysteries going into the next month is really what holiday spending is going to look like and how much the upper part of the income sphere can continue to support more broad economic activity that most retailers depend on for the entire year. I'm just wondering what the early signs are from your studies.
Well, the early signs are quite encouraging in the sense that our holiday spend tracker that, you know, just focuses in on categories that are particularly kind of seasonal, if you like. That's got a run rate of 5.7% year on year. I mean, the note of caution in that is that across this year, we see very little growth, if at all, in retail transactions, but we see an uptick in the money spent. So in other words, price increases, most obviously from tariffs, are, as John said in the intro, leading to people paying more but getting less.
I'm looking right now at this equation. So we're looking at spending growth at 5.7% year over year. Wage growth, however, for higher income is 3.7% year over year, 1% for lower income, the widest gap, tied with the lowest gap going back to 2016. Does this seem unsustainable in terms of how much the consumer is willing to absorb the higher prices? Or are you seeing a willingness to spend it and maybe just expand the credit balance that a lot of these households have, given the fact that they're coming from actually pretty well-adjusted levels?
Yeah, well, I guess there'll be some convergence. These Ks don't go on forever. There will be some convergence. So the big question is it, you know, in the middle, or is it towards the lower end? I guess if you're, you know, listening to Rick earlier and talking about the optimism around productivity, you know, if you're relatively bullish on things like productivity, then there's no reason to assume, in a sense, the economy should go where the labour market has gone, if you like, and sort of towards the lower end. Credit, pretty solid, really. You know, people have money in the bank relative to pre-pandemic still. There's a slight rise in people only making the minimum payment on their credit card. But again, that's not accelerating that rise. If anything, it's decelerating. So by and large, you know, there's sort of dry powder for holiday spending. And in aggregate, the K is concerning, but in aggregate, the pitch is quite solid.
David, how much are credit card owners still the representative sample that they used to be, based on the fact that an increasing proportion of people are using buy now, pay later, are using alternative sources of financing, and are kind of out of that credit card world?
You know, that is a great question. So certainly now, when we've looked at buy now, pay later, and we can look at people paying those debts off, I think last time we looked, the share of our households doing that was about 10%, certainly rising, but by no means everybody. And most people are quite light users of that, making only like 1 to 5 transactions a month. So I think it is something to watch, I think. And one of the reasons we exist at the Institute is to not just concentrate on credit card debt. We look at ACH, wires, all the other ways, P2P, all the other ways you could pay for spending. But it's a fair point. But I think right now, the card data still gives you a pretty decent steer.
David, always good to catch up. Thank you, sir. David Tinsley there of the Bank of America Institute. My takeaway from that is the K is concerning. The aggregate is okay. The aggregate is the Fed's position, right? That's where consensus kind of is, if there is one right now, which is that on aggregate, things are okay. The risks around it are problematic, but things are just about okay. The K is concerning, sure. The K is the problem for Washington, for the White House and for Congress, and that's what they've got to wrestle with into the midterms next year.
And the K will become a problem for markets because, as David Tinsley was just saying, the K will break at some point, and it's not just something that can go on forever. And the question is, which side is it going to break to? The Fed's grappling with that right now. Washington, D.C. is grappling with the fallout of a lot of social issues that are hinging on this.
Given the sequence and arc of earnings season, the attention is going to turn to the consumer again next week. Next week, we'll hear from Walmart, we'll hear from Target. Big spotlight on what's happening with consumption in this country, in the absence, of course, of retail sales at the moment. Equity futures on the S&P positive by 1/3 with an update on stories worldwide. Let's cross over to Yahira for your morning brief. Hey, Yahira.
Hi, John. Federal Reserve Governor Michael Barr is calling for guardrails as the financial sector looks to adopt AI. Speaking in Singapore earlier, he warned that loosening those standards opens us up to too much risk, from market manipulation to collusion. Plus, he worries AI could be trained on skewed data that could introduce new biases into the financial system. Meanwhile, banks in China are asking clients to take out loans and then immediately repay them, with the bank covering the interests. The practice is spreading as banks come under pressure to hit government-set targets that can't be met by real demand. Regulators have vowed to prevent funds from circulating within the banking system instead of flowing to the real economy. And shares of On Holdings are jumping 8.6% after the Swiss sneaker maker boosted its sales and earnings forecasts for the year. The company also posting a better than expected third quarter in which consumers in Europe and Asia bought on high-priced footwear despite trade tariffs weighing on the sneaker industry. That's your Bloomberg Brief. John?
Yahira, thank you. I just want to pick up on that story again. That right there is the problem with central planning. Banks in China asking clients to take out loans and then immediately repay them, with the bank covering the interest. The practice spreading as banks come under pressure to hit government-set targets that can't be met by real demand. What a story from the team this morning.
This really goes to the heart of a question: how much can China transform its economy versus pay lip service to it and create sort of metrics that seem like that's the case, but still really relying on the consumption side of, not on the consumption side, on the production side of things and the overcapacity that they have.
Just to take a step back, I think you're just spot on. This White House, and I'd say this Treasury Secretary, wanted this country and this economy to rebalance away from exports. What have we seen over the last year? Even with the tariffs, maybe a record trade surplus for the year for China. Exports are going everywhere else. What did we want to see? We wanted to see China boost consumption. What are we seeing based on that example? Can't even make the loans. No one wants them. That's a problem.
You can't change the structure of an economy by mandating it from the top. This has to go to a lot of incentives, and China has been reluctant to give some of the checks to average citizens in the same kind of way that the United States and Europe did during the pandemic. It was maligned in terms of the inflationary boost, but it did create activity and it did create consumption, and that is part of the problem right now for China.
That's the latest on China. Up next on the program, powering the AI build-out.
Where is the real bottleneck in this whole, AI process? It's really at the gas turbines in the grid. The grid is copper, and gas turbines are steel.
Jeff Curry of Carlisle, fantastic yesterday. Full conversation up on YouTube and, of course, on Bloomberg.com. We'll continue that conversation. Up next, we'll catch up with Amy Gower of Morgan Stanley from New York City. You're watching Bloomberg TV. Looking for a fourth day of gains on the S&P 500. The S&P this morning up by a third. Outperformance for big tech, and the Nasdaq up by 0.5. The tone of things out of the technology world is pretty good this morning. AMD talking up growth in the future. Hon Hai doing the same thing. We're up across the board here. Small caps higher by 0.4%. Under surveillance this morning, powering the AI build-out.
Where is the real bottleneck in this whole, AI process? it's really at the gas turbines in the grid. The grid is copper, and gas turbines are steel. So we have a lot of investment that needs to take place at that point in the supply chain before you can really begin to grow it. A lot of that capex spend that we're seeing, these $300-400 billion capex spends, a lot of that's going to go into the copper price and the commodity prices. That broader super cycle, we're witnessing it in metals.
So here's the latest this morning. The AI build-out fueling strong demand for industrial metals, adding to gains for the year. Amy Gower of Morgan Stanley writing, elsewhere the battle for power is heating up. Electricity-intensive aluminum smelting is competing with rising AI power needs. Amy joins us now for more. Amy, welcome to the programme. There was a hope that maybe these constraints wouldn't hit so soon. Are we already hitting them right now?
I think at the moment we are definitely seeing that particularly the electricity intensive commodities are running into some supply issues. So at the moment in the US, for example, there's a 50% tariff to import aluminium, but this is still not really driving the restart of idled capacity. And I think part of the reason for that is that the companies are just struggling to get the power, either because of power availability or because of the price that they're being expected to pay. So the US Aluminium Association has said, ideally smelters want $30 to $40 per megawatt hour, but some of the AI and tech companies are paying $100 per megawatt hour. So it's just very, very difficult for these kind of industrial metals to compete with the price for electricity that is playing out right now. And so that's driving the aluminium price higher. We have what looks like very, very strong margins for smelters at the moment, and so far that's not really showing any signs of abating.
Amy, you track some of these metals, other metals too, that are needed for this build out and for this transition, including the likes of copper. Which commodities of the ones that you track have proven to have the lowest supply elasticity? How much longer will we have to grapple with maybe supply deficits into next year and beyond?
Yeah, look, I think a lot of the metals that we cover have quite low supply elasticity, particularly on a short-term time frame. Because if we think about investing in a mine, these investment cycles are just getting longer and longer. So it's not necessarily the time needed to construct a mine that arguably hasn't changed very much, but the time needed for the permitting, the environmental approvals, the licenses, getting the local community on board, all of that is just stretching longer and longer. And so that's what processes like the Fast 41 program in the US are aiming to address, but this is not an overnight fix. So it's very, very difficult in the short term to bring supply on. Arguably recycling is one that can adjust a little bit more quickly, so often prices go up, recycled supply comes to market, but there's challenges there too. Particularly, I would say you want free trade for recycling to work well. You need the places where there is excess scrap metal, you need that to be able to transport to where there's the processing capacity, and at the moment with all these trade barriers and high cost of moving things around the world, that's also struggling. So it looks like both copper and aluminium, which are your key electricity conducting metals, it's actually quite difficult for supply to respond, at least on a sort of 12 to 24 month view.
Amy, I'm glad that you talked about the trade imbalances and some of what's going on geopolitically. I just wonder how much of a choke point China is over a lot of these metals, given the fact that not only do they produce a lot of them domestically, but they have their tentacles in different places, whether it's in South America or if it's in Africa, that are a lot of the suppliers of a lot of the raw materials.
Yeah, look, I think the growth that we've had in China's metals output over the last 10, 15 years has been extraordinary, and to the point where China is, I guess, increasingly self-sufficient, particularly if we look at something like aluminium. In copper, they are still a small net importer of refined copper, so arguably they're not quite there yet, but we are seeing the focus on securing that access to the upstream resource. So particularly in copper, you can build a smelter, anyone can build a smelter, but it's really getting access to that mined copper, and that's where China is focusing at the moment. And so I think that's where the West as well needs to be looking and making sure that projects are getting approved and we are moving forward to develop the resources that we have, which have so far been held up by long lead times, long environmental approval processes, etc.
To John's point about the elasticity and how quickly things can be brought online, and I'm wondering more domestically or nearshoring from that perspective, how much progress has there been made in terms of bringing some of the refining and other production capacities to the West over the past, say, year? Has it been a pretty exponential growth?
I would say actually so far we haven't seen a huge amount, and part of the challenge there is, if you take copper for example, to process a ton of copper concentrate into refined metal, smelters are actually having a negative margin for the most part. So what they get paid to process that copper is a negative number, and that's partly because of this overbuild of processing capacity around the world. So it's not that there isn't enough processing capacity, it's all concentrated in a few places. So actually for then somebody to make that investment is quite tricky if the margin is negative to then say we're going to deploy capital here. So I think we haven't actually seen all that much progress yet. And then going back to aluminium smelters, arguably there is quite a lot of idled capacity in Europe and in North America. In Europe we are making some progress with some restarts in Germany and Spain, but we're not. There's still a lot that's idled, and the challenge is just getting that 5 or 10 year power contract at a reasonable price that companies can then use to run, to make that restart decision for the next sort of 10, 15 years of their business planning.
Amy, for capital allocators right now, what's the best way of playing this story? Expressing this as a trade?
At the moment, we like aluminium. We think the combination of the China capacity cap, where China is no longer adding to supply, which has been a key challenge for the market for the last 15 years, is China over adding capacity, combined with some supply outages, and then also probably a lower likelihood of restarts outside of China, is keeping the supply side very constrained. Against that, we've got a good demand backdrop. The aluminium is the key substitute for copper, and so where there's price incentives, sometimes you can get switching. And we think as well the growth in Indonesia, which many are looking at as something that could derail the rally, we think that's not a problem for next year or probably even for the year after. That's something that's going to take a bit longer to build out.
Amy, thoughtful stuff as always. Let's do it again soon. Amy Gower there of Morgan Stanley on aluminium.
Yeah.
I've been converted.
Oh, yeah?
Aluminum, but it's nice to hear aluminium. Just every now and again.
I actually think it's pretty poetic. Aluminium. Actually, no, it's not. I just absolutely butchered it. I can't do it. It's aluminum. I mean, if you're growing up with something, it sort of sticks. The point here about what China is doing is so crucial to these trades. I was thinking, okay, so much more is going to hinge on batteries, right? And even if the U.S. is really pushing back against some of the EVs, electric vehicle production, you still can imagine lithium would be a good spot. Lithium prices have absolutely cratered. Why? Because of overproduction in China. So it's such a complicated story, even if the overall theme seems pretty obvious of we need to build the infrastructure.
China seems to be at the epicenter of all of it.
100%.
Yeah, and that's the problem for this administration as they try and work out how to become less dependent on the China story. Coming up on the programme, we'll catch up with Julie Biel of Kayne Rudnick, Jay Goldberg of Seaport Global, Sarah House of Wells Fargo, Ivy Zelman of Zelman Associates. We'll be having a conversation in the next hour on a 50-year mortgage and what it could mean for this housing market.
Will it lower prices? Will it actually juice some sort of housing market activity? Honestly, this has been the strangest area of the economy and, frankly, the most politically charged one as so many people get locked out of the homeownership market.
If you're just joining us, welcome to the programme. We're positive by 1/3 on the S&P and looking for a 4th consecutive day of gains. The bond market reopens with lower bond yields. We're down by almost 5 basis points now across the belly of the curve. From New York City, the third hour of Bloomberg Surveillance. Up next.
We have been experiencing one of the biggest and largest momentum markets that we have had since the late 90s.
I think we are in a little bit of a wait and see moment.
The volatility and the rotation that we're seeing among single names is healthy.
There's a chance we get a significant 5 to 10% pullback.
Looking into next year, we are more optimistic.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
So the gains continue, not a million miles away from all-time highs on the S&P 500. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And we add some weight to the rally with futures up by 1/3% on the S&P, up by 0.6 on the Nasdaq. In the bond market, we reopen with lower bond yields across the curve. 2's down by 4. 10's down by close to 5. We're down to 4.07%, going into a week full of Fed speak. Coming up later on today, Governor Waller, Governor Myron, New York Fed President John Williams as well. And look out for this at 10:45 a.m. Eastern Time. We'll hear from the Treasury Secretary, Scott Bessent.
Yeah, trying to understand exactly how to frame an economy that's in flux. We caught up with Rick Rieder just a bit ago here on Surveillance, and he was talking about the same thing that Mary Daly of the San Francisco Federal Reserve is talking about, a transformational change that's creating a real tension right now where you could get a productivity boom without the accompanying jobs. It creates a real quagmire both for the monetary policymakers as well as for the Treasury Department.
They've got a problem in the labour market, a problem that we need to address, a problem that we need to address fast. The question I would have, is that the responsibility of monetary policy, the Federal Reserve, or the responsibility of Congress, the government, Washington, D.C.?
Yeah, and this ultimately will come down to probably both to some degree. Even if people say this isn't a monetary policy problem to fix, increasingly what you're hearing from potential policymakers and existing ones is you need to kind of run the economy a little hot in order to keep people employed at a time when they're becoming less relevant in a technological shift. And right now, the rates they control are more of the rates that actually are things that feed into consumption in the lower end of the economy rather than the overall stock market. Although a lot of concerns here, too, is stocks at pretty high valuations.
The jobs data is super relevant to the politics, without a doubt, and for the broader economy. There is no doubt about that. How relevant is it to the broader stock market when the forces that are driving the stock market right now are the very forces that are undermining the labour market, to some extent at least, over the last year?
If you look at what companies have said, when a company announces layoffs, efficiencies, their stock rallies, because right now they can do more with less. And that's what we saw from Paramount Skydance, and that's what we saw from Amazon, and that's what we saw for UPS. And when you take a look at all of these efficiencies, you start wondering, is this a feature or a bug of the stock market rally that hinges on new technology and greater efficiency?
Can this decoupling persist? Or is that tension going to snap back things one way or the other? That's the story of the moment. That's where the tension is. Equity futures on the S&P up by 1/3%. Coming up this hour, we'll catch up with Julie Biel of Kayne Rudnick as stocks are edging higher. Jay Goldberg of Seaport Global on AMD's accelerating sales growth. And Ivy Zelman of Zelman & Associates as President Donald Trump's 50-year mortgage plan is losing steam. We begin this hour with stocks rising, the S&P 500 pushing for its fourth straight day of gains. Judy Biel of Kayne Rudnick writing, the setup for the first half of the year should be positive. I'm encouraged this earnings season to see estimates holding steady for year-end versus typical softening, and estimates look solid in 2026. Judy joins us now for more. Judy, welcome to the program. Let's talk about that earnings growth and your projection for the next 12 months or so. Where's that growth coming from and how broad-based is it?
I think you're seeing a broadening beyond the kind of core AI names. For sure, they'll be part of the story. We expect that, and that should continue. But I'd love to see more of a broadening in terms of industrial names that are seeing better productivity. And, what we would love to see is healthcare really start to participate more. And I think I'm hopeful and optimistic that it's not broader just in terms of sectors, but market cap as well.
We'd love to see it too. Hopeful, optimistic, right there with you. Are there reasons to be hopeful and optimistic?
Yeah, I do think that a lot of what's happening in small cap is more favorable financing conditions, and that's enabling a lot more earnings growth. If they don't have the same level of interest burden that large cap has had, that helps them for sure. It also kind of helps loosen the conditions in terms of their businesses in the industrial sector, for example. Healthcare, to me, is more a function of what's going to happen with the FDA and the government, and can we clarify a little bit of, where the CMS cuts are going to be. Looking forward, for me, what's in the Russell that's the most important is just seeing that the consumer can still hang on and hold in there. If we have a deterioration in the labor market, I don't think that's good for anyone, but I think that could particularly be problematic for the Russell.
Which really raises the issue, Julie, of the action that we're seeing today in markets. And I understand that one day is just one day, but we're seeing bonds rally on the heels of some less positive news coming out yesterday, less positive data, at the same time that you're seeing futures rally, in particular the Russell 2000. Does this work for you? Does this seem like a coherent picture, or is something amiss?
It's not a great picture, right? For the most part, I try to be in the good news is good news camp because I think that's the more important factor. It's not great when what's driving, what's happening in the Russell is just a function that interest rates are lower, and so non-earners, can have a better valuation. What you want is that the fundamental growth, the earnings picture to be improving, not just interest rates are coming down, and so, biotech businesses look better valuation-wise.
Heading into year-end, though, at this point, you just want to ride the rally, go into the most popular names because it feels like the Santa Claus rally is gaining some steam and people are getting excited, sentiment following sentiment?
I think it's more important to make sure that as you come to year end that you feel very good about the underlying quality of your business because there are enough headwinds and heartaches that are in front of us. I don't think that it makes sense to just bandwagon on things that you don't have a lot of confidence in. So, there are parts of the AI trade that are lower quality and they're really, really dependent on AI continuing at this feverish pace. Those are the names that I would avoid, the kind of tangential connected names, the ones that are the core winners. Look, if AI goes away tomorrow, Google still has a monopoly on search. They're still fine. That's what I think is important, is that your business model really matters.
Julie, next week we'll talk about the business model of the retailers. So Target a week today, a week tomorrow we'll hear from Walmart. What are you expecting to hear from these retailers?
I think Target, for the most important thing for Target is kind of the level of execution that they've had has been pretty poor. And so any indication on have they got their act together a little more is helpful. Walmart, I'm really curious about this lower income consumer. Part of what I'm worried about is that we've seen this immigration outflow that's pretty meaningful. And so is it a function of their low income consumer is stressed and spending less, or are there just fewer of them walking in the door? That's a really important component in terms of understanding what's happening in the labor market, because immigration has both boosted and hurt us in the most recent 3 or 4 or 5 years. So I'm really curious about that. And then what is going to be the setup for holiday? How are people thinking about pricing? Because of tariffs, I have this sensation that maybe we're going to see less discounting. And how does that impact pricing and feels about that?
So, Julie, what we've seen from the restaurant business and what we've heard from fast casual is they're struggling to put up prices. They're getting pushback from the consumer. Is a retailing world a different world, or do they have to experience the same themes?
I think it completely depends on the merchandise that you have. If you are differentiated and your consumer is doing pretty well, then you're fine. But I think what the real question is going to be is, now that we have inventory that has been tariffed, right? We had been benefiting from people buying ahead earlier in the year, but now most of the inventory that's going to be in the stores is going to have tariffs on it. It's a question now to the retailers and to the manufacturers themselves is, what is your acceptable level of profitability? Are you going to try to pass on price maybe early on in the holiday season? And then if there is a weakness in demand, do you start to discount aggressively?
Julie, how much can you extrapolate a macro trend from these specific company reports? The idea that if some of these companies are able to pass along price increases, that makes you think, okay, maybe inflation can run a little bit hotter and I should do something with my overweight duration.
I think it's a function of mosaicing in terms of all of the information, right? What you're trying to do is put together a really cohesive picture. And often what ends up happening is that the idiosyncratic things of a certain retailer will actually kind of throw you off. It's not that, Target is the customer that Target is serving is actually doing that badly. It's just that their execution is poor, for example. Or it's not that certain retailers like, say, a Lululemon are really struggling to get product that people care about means that their consumer is weak. So it's not that you want to be overly dependent on a single comment, but just like we were talking about with the restaurants, they're having trouble being able to push price. You're able to draw certain conclusions about certain segments of the income population and then make a decision about where you think the health really is.
Based on the fact that some of these specific companies can be noise in terms of the overall macro signal, how much of a liability is it for you that we haven't gotten the government data that a lot of people rely on, that we might never get some of the data points?
Yeah, I think that is probably the hardest point right now, is that the quality of the data was already not excellent, right? We can kind of all agree about that. But not having it at all makes it really, really difficult. And some of the newer data series that we're getting, like Challenger, they haven't really been tested in terms of getting a strong sense that there's a lot of signal to be gained. And so not having the economic data and the jobs data in particular most recently, to me, that makes me pretty uncomfortable, because I don't think we're going to really have it. I think we're just going to be looking forward with data, and hopefully that gives us some indication. But we basically have this air pocket where we don't really know what's happening in the economy, and we have fears in terms of all of these layoff notices that we've been getting.
Julie Biel of Kayne Anderson Rudnick. Julie, thank you. Referring, of course, to the Challenger job cuts of the last week, which I might have described as Tier 3 or T4 data. And I got this message from a Bloomberg subscriber who said NFP was revised down by something like 1 million jobs in the last year or so. Which data is Tier 4? Exactly.
This is the point that a lot of people have been talking about, which is non-farm payrolls is highly imperfect and often is revised in a significant way. And yet without it, life is so lonely. It doesn't have the cadence.
Well, Fridays, I'm with you. The rhythm and the cadence of financial markets, that first Friday of the month, you get payrolls data. It just sets the foundation for the conversation for the month ahead. And then in about 12 months' time, everything gets revised and those conversations were maybe misplaced.
Look, the data
That's the cadence, right?
That's the cadence, and at least we can play into the cadence. And right now, without it, people are getting sort of whizzed around when it comes to challenger job cuts or ADP weekly data that doesn't have a long historical series that really it relies upon. So you start looking at these data points and you start wondering, is this introducing more volatility than it's worth into the market?
Certainly putting more emphasis on things that we wouldn't traditionally put emphasis on. Equities this morning positive by, let's call it 0.3% on the S&P 500, higher by 0.37. Let's give you an update on news worldwide with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. The U.S. House of Representatives is gearing up for a vote to end the longest shutdown in U.S. history. The short-term funding bill was reached after senators agreed to compromise on a plan that will fund the government through the end of January. The measure would reinstate federal workers fired during the shutdown and guarantee back pay for furloughed employees. Meanwhile, supporters for UK's Prime Minister Keir Starmer have privately accused Health Secretary Wes Streeting of plotting a leadership challenge against Starmer. Streeting has dismissed the allegations as not true and repeatedly reaffirmed his support for the Prime Minister in an interview. The reports come just weeks before the government is due to unveil a contentious budget. And aviation leaders saying flight schedules won't immediately bounce back after the government reopens, adding that residual effects will be felt for days. And Transportation Secretary Sean Duffy is offering no timeline of when flight restrictions might end. Tune in later at 12:10 p.m. Eastern for Lisa's interview with Delta Airlines CEO Ed Bastian here on Bloomberg TV. That's your Bloomberg Brief. John?
Yahara, thank you. Looking forward to it. Ed Bastian of Delta coming up on the programme later on this afternoon. I asked this question yesterday. Outside of Delta and maybe United Airlines, what is left of this industry right now? They are in a world of pain.
And when you take a look at the likes of Delta, how much of their revenue and profits come from the premium cabin, as well as the loyalty, it is an increasing proportion of their overall profitability. How far can we push that? How far can we see that go where suddenly the bulk of the plane is premium and the capacity in the back is smaller and really all the profitability comes from there? Is this the model or is this going to hit some sort of stopping point?
Don't miss that conversation at about 12:10 Eastern Time later on this afternoon. Lisa catching up with Ed Bastian of Delta Airlines. Up next on the programme, the morning calls plus AMD rising on expected sales growth. That stock is higher by more than 6% this morning. Live from New York City, good morning.
In terms of this new infrastructure build-out, the demand exceeds the supply. For the next 3 years, the demand is so strong, actually, you're being underwritten by very, very high-quality borrowers. Today, these hyperscalers they're a better credit rating than France.
That was Hugh Van Steenis of Oliver Wyman. The capital needs for the AI build-out are absolutely massive, and they're growing day by day. Equity futures on the S&P 500 this morning, positive by 0.4%, up by 0.6 on the Nasdaq. Thank you, AMD. Let's get you some morning calls with that one stock in focus. First up, Wells Fargo raising its price target on the stock to $345, citing its stronger than expected financial framework. Next up, Mizuho raising its price target on AMD to $285, forecasting sales growth through 2030. And finally, Evercore raising its price target on the stock to $283, citing optimism around its ramp and share gain. That stock, Lisa, up by 6%.
Again, I can't get over the dissonance between today and a week ago after they reported earnings and people came out and said it was good, but not good enough. And, you know, this could be a bubble, the B word, right? And so there's this question of what's changed from then to now. This has been a stock that's been absolutely outperforming so far this year. It also has shown that it is outperforming on the underlying fundamental backdrop. Last week, it wasn't good enough. This week, it looks pretty good.
This morning, it's driving this stock higher. The CEO, Lisa Su, expecting accelerating sales growth on strong demand for data centers. Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, good morning, sir. Big move for that name. What's behind it?
Well, I think what they did yesterday was to give specific targets in terms of what the growth trajectory may look like through 2030. That wasn't the case when they reported their quarter. And look, I think the thesis here is a lot of the existing systems are going to be rewritten with a GPU or an accelerator framework in mind. And, you can talk about the new AI applications that will come to the scene, and some of them have, including ChatGPT and Cursor and whatnot. But rewriting existing systems with GPUs or accelerators, that is the type of driver that will take this market to $1 trillion by 2030. And AMD's prior forecast was $500 billion. So clearly they see something on the horizon in terms of what's going to carry the demand, through 2030.
Mandeep, can we talk about the source of that demand? How much of this hinges on the spending commitments of one company, say OpenAI, going forward from here?
Well, so look, I think there are a lot of questions to AMD around that 6 gigawatt, contract with OpenAI and how it's going to build out, given OpenAI doesn't have a strong balance sheet like the other hyperscalers. But in the end, if compute is needed for all the existing applications that we run, then, you can finance it, whether the hyperscalers raise debt or, there are other entities that come to, support this build out. So it goes back to the sustainability of demand. And, you don't want to risk it to training the next version of ChatGPT's model. But you are willing to, invest if it's going to be used in existing applications. And I think that's the big difference is you're not pinning your hopes on these models constantly improving by, scaling laws or something like that. And I think that is what has changed in the past 6 months.
Mandeep, AMD is pretty interesting because it sits somewhere between NVIDIA and Intel. This idea of the hyperscaler GPUs versus what we use in our computers and some of our day-to-day electronics that people have known. Is AMD eating Intel's lunch with the profits that it's getting from the GPU land?
So clearly, they talked about how this GPU wave and the accelerator demand is also going to drive the traditional CPU compute. I mean, think about, an existing workload right now uses a certain level of compute resources. It's going to 5x or 10x in the age of AI. And that applies across any type of workload. So from that perspective, what they're saying is they have the best CPU right now, better than Intel. And they will gain share when it comes to both the CPU market, as well as taking some share from an NVIDIA or some of the accelerators that are out there. But their value proposition is offering all types of compute for workloads that are being deployed at enterprises.
I guess another way to frame this, Mandeep, is are there going to be winner-take-all types of dynamics in the chip space, just based on what kind of scale you need to really execute and compete in this space right now? Is it going to be AMD and NVIDIA at the top and everyone else a two-bit player?
I mean, I wouldn't take out Google TPUs. So one of the things we have seen this year is, yes, NVIDIA has done very well, but also Google is looking to commercialize their TPUs outside of their own workloads. And so from that perspective, the hyperscale threat is always there for, NVIDIA, AMD, and Broadcom, because these guys are doing a lot of things in-house. But with that being said, what NVIDIA has shown is they have a clear path to $500 billion in data center revenue, and that's not changing anytime soon, even though competition is there. And like I said, Google TPUs is doing well. But this market is large enough that, all these companies can still do well.
Mandeep, did you see some of the conversation with Brad Gerstner of Altimeter, with Sam Altman and Satya Nadella? You're nodding along, so I assume you did. Mandeep,
yeah, I did.
There was a moment in that was kind of uncomfortable. Brad asked a really straightforward question and a very fair question. He talked about the level of revenue right now and compared it to the spending commitments they had several years out and asked for an explanation. And Sam Altman became really defensive about it and essentially turned around to Brad and said, if you want to sell the stock, there'll be someone else that can buy it. Mandeep, I didn't think that was a very good response at all. What was your impression from Sam Altman's reaction to a very straightforward question?
I think no doubt there is an acknowledgement that 1.4 trillion spend is a big number, especially when you are at a run rate of $13 billion in ARR. Yes, you talk about, $100 billion in ARR over the next 2 years, and you're the fastest growing company. But still, there's no doubt that, it all hinges on execution. And for, the private market to underwrite a lot of debt related to that, I mean, there is a lot of execution-driven hope that, you're pinning on OpenAI being the leader and the hyperscalers not being able to catch up. I mean, what Google has shown this year is not only has Gemini gotten better, but they have a play with the vertical integration with the chips that they have, the TPUs. And from that perspective, you can't just, be assured that OpenAI will be the leader throughout this 5 years. And so from that perspective, I think it's a fair question to ask. And look, I think Sam Altman is confident that the model will remain the leader when it comes to the frontier models. I mean, Chinese models are open source. So from that perspective, you could question the unit economics. And that's where the biggest question mark is around OpenAI, is the unit economics. Will it be a profitable endeavor when it turns to be a $100 billion run rate company? And I think right now, it's all upfront spending. So that's why I think it's a fair question to be asked.
Mandy, what are the cash needs of that company at the moment? I've seen estimates that it's close to like $500 billion valuations in the private market. Do you anticipate they will be going public soon?
Well, they are changing that nonprofit structure. And I think with the revised structure, there is a chance that they will go to the public markets as well. With that being said, there's no doubt that this is not an 80% gross margin business. This is more of a 40 to 50% gross margin business, even at, scale that they are talking about. So the fact that you need a lot more compute for running your software just goes to show that, software gross margins are not the same as they used to be. And so from that perspective, you have to account for the lower gross margins of companies and higher spend on the chip makers, which is what we are seeing in the valuations of NVIDIA, Broadcom, and all the other peer group.
Mandeep Singh of Bloomberg Intelligence. Mandeep, thank you, sir. Enjoyed this. Appreciate it. Thank you very much. If you haven't seen that conversation with Brad and Satya and Sam, not my friends, I should use their full names, you should watch it. It's actually a really, really interesting, revealing conversation.
Two ways to interpret it. On one hand, he's got something to hide and he's frustrated and he's pushing back. Another way is he gets so much pushback about the spending plans and the profitability questions around OpenAI that he's exhausted and that he's just frustrated with it. And he's just saying, if you don't believe in my story, then short my shares once they go public or try to, get out. And that's, I guess, the real story of the market right now.
It just felt a bit awkward. Let's put it that way. Equity futures on the S&P 500, positive by 1/3%. The opening bell about an hour away, and tech is doing better than good so far this morning, driven by the latest news out of AMD. Up next, we'll catch up with Sarah House of Wells Fargo, with Wall Street hoping for official data to get back to work, and Danny has some morning movers for you. On holdings, up by 8%. So first come the tax refunds and then comes the tariff relief. The Treasury Secretary, Scott Bessent, speaking right now and saying that we'll be talking about substantial tax refunds coming in early 2026, and saying this on tariff relief. We're going to unveil tariff relief on coffee and other items. Bananas and other fruits also set for tariff relief. Affordability is the dominant word down in Washington, D.C. right now, and it looks like, based on those comments, the Treasury Secretary is responding to them.
If people see their coffee prices go back down, how much does that affect their feeling about cost of living and just how much prices are going up? Talking about how they are going to respond to a spotlight that has been shown on the fact that people are worried about inflation, that they're worried about the absolute cost of everyday goods. Can you selectively take tariffs off certain items? Say coffee in the morning, say your eggs that you have for breakfast, while still keeping them on in certain areas.
You can't hide from that. People experience those goods every single day. It's what UBS has talked about. The frequency bias. You have a coffee every single morning. You see the price of that go up. That's going to shape your view on the economy and on inflation, regardless of what inflation is elsewhere. And this is the problem with the gaslighting of the previous administration, when they were telling people there wasn't a problem and they could experience a problem. That is the issue right here. Don't fall into that trap. That's the mistake of the Biden administration. Don't fall into that trap. Listen to what people are saying. They're saying they're struggling. They're saying there's an affordability problem. You've got to respond to it. Otherwise, you will get crushed.
Yeah, well, President Trump has been saying that actually prices will go back down, and how much is this sort of a push to do that, and saying things are actually pretty good. How do you have things are pretty good and you get a $2,000 rebate? I mean, there are a lot of questions that you have in terms of coherency of message right now, but nonetheless, what really is the main driver right now is cost of living is going to cause policies to shift, and that is what we're seeing in Washington, D.C.
On that $2,000 rebate, this headline just crossing, the president talking about a $2,000 rebate for families earning under $100,000. The president alluded to that over the weekend. It feels like this is moving forward, like this might actually turn into real policy.
I'd like to see exactly how that factors into the tax policy that's already planned and what that does in terms of the budgeting around some of what has already been proposed and what exists, because that is going to be the focus of the bond market.
We'll come back to some of these comments in just a moment. Just to take the temperature of the equity market, doing okay, up by a third of 1% on the S&P, on the Nasdaq up by 0.6, with some single names, some morning movers. Let's cross over to Danny for more. Hey, Danny.
Hey, John. Can't keep some of these cloud and AI names down for too long. CoreWeave, on the back of a very bad day yesterday, where it fell 16%, is up 3% in the pre-market, so not making up for the entirety of losses. But still, we are seeing dip buying. It comes after CoreWeave gave earnings, where their revenue outlook disappointed, and it's lost a third of its value this month, so a very tough run for CoreWeave. Octo, the nuclear energy company, reporting earnings this morning, a boost to their cash and cash equivalents. That's seen as a positive, alongside the fact that they are focusing more on Department of Energy contracts. Dan Ives of Wedbush saying that they are powering the nuclear revolution in the U.S., so those shares up just under 3% this morning. Finally, on one of the other earnings we had this morning, a huge rally this morning, up 11%, a beat and a raise on their behalf. The strongest regions were Asia and Europe, but you did see some growth in North America, a little bit less than expected. But they pointed out, despite the fact that they raised prices in July, the tariffs were a big concern. People are still willing to buy what is the most expensive running sneaker on the market, John.
Stock is up by almost 12%. Danny, thank you. Looking forward to the program. Danny Berger, Matt Miller, taking over in about 27 minutes' time to guide you into the opening bell. Let's turn to the economy. U.S. Secretary, Treasury Scott Bessent, set to speak at the New York Fed later on today. Bloomberg's Mike McKee joins us now for more. Mike, good morning, sir. Some comments already from the Treasury Secretary just moments ago.
Yeah, there are two Scott Bessents. There's the Scott Bessent who has the Treasury Department responsibilities, and then there's the one who has to defend the Trump administration on all sorts of weird topics like coffee and banana tariffs. Remember, the tariffs were supposed to be put on things that we make in America that are being brought in, so we'd make more, but we don't make any coffee or bananas. So I'm not sure how great a job that means the administration is doing. But the nerd version of Scott Bessent will be at the Treasury Department today. It's an annual conference that the New York Fed puts on, talking about the plumbing, the functions of the Treasury market. And they'll be looking at things like the resiliency of the market, what's going to happen now that the Fed is ending QE and asking banks to use the standing open market, the repo facility on a regular basis, that sort of thing. I don't think we're going to get a political speech from Bessent at this meeting, although he might talk some about the president's fiscal policies and what they might mean for debt for the U.S. And there are other issues that the Treasury Department has, including what they're going to do about buybacks. Are they going to buy more debt back than they have? And where are they going to issue along the Treasury curve going forward now that the Fed is not the buyer of last resort?
Mike, are we seeing some acknowledgement, though, this morning from the Treasury Secretary that people are struggling and they need to adjust? We're talking about tariff relief, tax rebates. That's something new in the last few weeks.
Yeah, it is new because the Democrats did very well running on those issues in the the off-year election, call it. And the administration seems to have pivoted very quickly to try to grab that issue back. And you're going to hear a lot from all of the members of the administration who are talking about this. And Bessent is one of those who is on television a lot. So he's going to be pushing those issues. But of course, he doesn't have anything to do with tariffs. And the idea of the dividends, we don't exactly know what that means. So I suppose he'll get asked about that a lot as well.
Mike, thank you, sir. Looking forward to your coverage. Mike McKee of Bloomberg. This is what Jared Seaberg of TD Cowen said last week, and I keep going back to this quote, and I keep giving Jared a shout-out. We expect Democrats will make the economy the key message heading into the midterm election. The president may respond by embracing populist policies, including some he raised during the campaign. There's a slow turn emerging here down in Washington.
Yeah, including checks, $2,000 checks to people who earn under $100,000. This is going to raise a question around the economic profile of the first quarter. If people do get checks, these are people who are predisposed to spend more of that money, which will find its way more quickly into the economy. And it also raises questions longer term. What kind of policies are actually going to get through?
Here's the view of Sarah House of Wells Fargo, writing, the absence of broad-based layoffs suggests the jobs market is holding together, even if the risk of a more meaningful slowdown cannot be ruled out. Sarah joins us now for more. Sarah, welcome to the show. Just to pick up on those headlines from the Treasury Secretary, if we start seeing $2,000 tax rebates, if we see significant relief early next year, how would that change your outlook?
Yeah, so I think already we're looking for a pickup next year just because you have some pretty favorable tax policy coming out where consumers are going to get pretty big refunds come the early part of the year. And so if you add $2,000 rebate checks on top of that, I think you would get a meaningful pickup in spending through the first few months of the year that could help, I think, balance out, I think, more of the components of GDP that we're seeing, where maybe it's at least temporarily a broader based increase in overall consumption rather than one that's being driven more by your asset owning higher income households.
Sarah, we saw a taste of this, and I know it's not the same thing, but during the pandemic era checks that people got, and a lot of people attribute the inflation that we saw in the pandemic era to some of those particular checks. Do you think that there'll be a similar dynamic, or do you think these are too small and not regular enough to have that kind of transmission mechanism?
Well, I think there are a couple important differences there. So yes, if you're injecting cash directly into households, especially your lower income households, they're going to go and turn around and spend that. But there's other sides of this that are different. So you don't have the same degree of supply constraints. You don't have, I think, the labor supply issues that we had at that time, where it wasn't just the increase in demand that I think led to the pandemic era inflation, but it was some pretty unique supply factors. So I think overall, rebate checks, even the larger tax refunds that we're expecting, I think that's going to make it harder for inflation to continue to grind lower. But I don't think that it would be something that would necessarily respark a sustained pickup in inflation again. I think it would just more derail the path, or at least slow the path of disinflation that's set for the second half of next year.
Sarah, the implication here is faster growth and potentially an expanded fiscal deficit in order to finance a lot of the programs that are being proposed, likely will be proposed heading into the midterms, not just by one party, frankly, both parties talking about similar types of responses. How are you factoring that into your economic outlook at a time where there already have been some concerns raised about the U.S. fiscal trajectory?
Right. So I think, again, if we're talking about one-off checks, this is only a temporary boost. So this is not something that's going to be fundamentally sustaining the outlook for the consumer. And to the extent that it does increase the deficit, then you're going to be seeing some of that feedback into yields, which is also going to flow through to other things, so potentially mortgage rates. And so it's not a panacea for, I think, really reviving the sluggish pace of growth that we think we're hitting here in the fourth quarter, maybe in some of the early parts of the first quarter, given that there are going to be some feedback sides of this in terms of what happens with borrowing costs.
Sarah, what should anchor our view of the labour market right now? I think that's the question of the year for the labour market. Employment growth is super low, but the unemployment rate is also low as well. Do you think the employment growth maybe overstates the weakness, or does the unemployment rate overstate the strength?
Yeah, so I think the hiring rate, I think it does overstate the weakness, given that some of this is supply. But I think we can't chalk it all up to the immigration story, for example, or just the ongoing population aging, where we are seeing demand continue to weaken. So look at Indeed postings, look at the PMIs, whether it's the ISMs or the Fed, still showing employment in contraction territory. And so I think there still is a demand problem here. And I think even if that break-even rate is lower, that still portends portend something for what's happening with household income and therefore spending power. But when we step back and I think at that main point that we need to keep in mind, it is where we are in terms of that overall balance. That's what the Fed is looking at. And I think there we are seeing some softening, but not in a material or quick way. So it's just this gradual ongoing softening that's keeping the Fed on edge, but not definitive in terms of the labor market really being in trouble here.
Sarah, what is your best guess for the Federal Reserve on December 10th?
So we still have that they'll cut another 25 basis points. So obviously that's a close call where it doesn't look like we're going to get even the November data that we usually would have had with the shutdown ending. I think the CPI, we're not going to have that for November. It's going to be a close call of whether you get November employment. But I think the overall position of, look, we need to move closer to neutral. Inflation, yes, it's being temporarily held up by tariffs, but you're not seeing that spill over into services. Path there is still lower. I think that still supports the argument of moving towards neutral. And I think when you look at the voter composition too, that some of the more outspoken hawks are the people who have come out and said, look, I'm having trouble supporting another cut. They're not voters. So I think when push comes to shove, we'll get that additional 25 basis point cuts in December.
A few of them will be voters next year, so we'll see what happens for next year. Sarah, thank you. Sarah House of Wells Fargo setting up December. So we probably won't have CPI, and it'll be a close call if we get November payrolls. That's what Sarah just said just then.
Yeah, and frankly, we just got a note from Andrew Hollenhorst over at Citigroup saying that we could get the September jobs report maybe in the next few days. The October jobs report might be delayed until early December. So then, imagine that you're not going to get the November report on time either. Think about people getting back to work, being asked to work overtime, and there are 30% fewer people in those offices. It's going to be kind of messy down there.
Yeah, we go from flying blind to driving in the rearview mirror.
Exactly.
It's going to be fun, isn't it?
Well, it's foggy driving. This sounds like a nightmare. God.
Yeah, December 10th is going to be an interesting one. Plus, they've got to put out some projections as well, some guesses about the future. So that'll be fun for them and everyone on the FOMC. Let's give you an update on stories worldwide with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. Treasury Secretary Scott Bessent saying just moments ago to expect substantial news on President Trump's sweeping tariffs in the coming days. He said the administration is planning tariff relief on coffee, bananas, and other fruits. He also said the president is considering a $2,000 tariff rebate for American families making less than $100,000. Meanwhile, Citi is selling its banking operations inside Russia to investment bank Renaissance Capital after an order from President Vladimir Putin. Citigroup announced back in 2022 that it would wind down its consumer and commercial banking operations in Russia following the invasion of Ukraine. The Russian government confirmed the sale, but offered no other details. And Wall Street's elite are heading to the White House for a dinner with President Trump later this evening. JP Morgan's Jamie Dimon, NASDAQ's Adina Friedman, and Goldman Sachs' David Solomon will be among those attending. The dinner comes as Trump faces rising pressure on the economy and affordability, testing his relationship with business leaders. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate it. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Ivy Zelman of Zelman and Associates as President Donald Trump's 50-year mortgage plan is losing steam.
Housing today is 3/4 of the wealth. If you actually get the mortgage rate down a bit, then what happens is all of a sudden you get housing velocity. Why is housing velocity important? Because you get labor mobility. For every home built in this country, we hire 3.1 people. It's pretty hard to AI building a house. So if you can get some real estate velocity, and by the way, it's why young people who are struggling today, young people who aren't savers, who are borrowers, that's the way they build wealth. That's the way you put people to work.
Rick Rieder of BlackRock weighing in on the housing market a little bit earlier on this morning on Bloomberg Surveillance. Sticking with housing, the president has got a 50-year mortgage plan and is struggling to gain traction in the industry. Ivy Zelman of Zelman, a Walker and Dunlop company, writing, while pushing for better affordability is a good fight to fight, the likelihood of a policy moving the needle on home buyer affordability in a tangible way is quite low in our view. Ivy joins us now for more. Ivy, welcome to the programme. You've experienced it all in housing. What was your reaction to the prospect of a 50-year mortgage?
Well, it's good to see the administration is trying to help, today's prospective buyers by improving affordability. But I think we have a lot of impediments with a 50-year mortgage. To begin with, while the monthly payment, if you just took the same mortgage rate, same home price, would actually go down, the problem is by adding 2 more decades, investors that would have to purchase those loans would require a higher rate. Our mortgage contacts that we survey think that rate would probably be close to 35 to 50 basis points higher than the 30-year fixed mortgage rate, therefore sort of wiping out the benefit, but not entirely, but most of that benefit. But even more importantly, right now, because of Dodd-Frank that was passed in 2014, Fannie and Freddie, who purchase more than half of the loans that are originated in this country, cannot purchase a loan that has a duration longer than 30 years. So we would need congressional approval to have that to come to fruition. And lastly, I think that today's consumer, while entry-level buyers think about monthly payment, so any reduction is helpful, it is the long-term how to build wealth, because people really don't save. So by owning a home and long-term equity appreciation is a way to create wealth. By having a 50-year mortgage, you're definitely going to create a lot less equity over time or have equity appreciation. So I think those are some of the concerns that we have. And I think that right now the industry has poo-pooed it enough that it's losing steam with the administration.
Ivy, what do you think the solution is? I'm sure there's not a magic wand, but what would you implement? What would the remedy be?
Well, I think housing, it's rather complex than just looking at one variable to assume that that would help ignite more activity. I think the builders are doing everything they can to provide more affordable housing, predominantly using mortgage rate buydowns, which has been a very successful strategy to keep velocity or growth growing, despite rates and affordability being at the worst levels in 40 years. But really the impediments for more housing, mortgage rates have to come down, or incomes have to rise more, or you have to have home prices come down. So it's really not a magic one variable solution. We do think most of the impediments for building more at more affordable prices come at the local market level.
Ivy, do you think that if interest rates were to go lower and mortgage rates were to follow suit, that it would cause housing prices to go up or go down because it would allow people to move who've been locked in their homes?
I think mortgage rates going down would actually help. I don't know about how much a home price appreciation we would get. I do think that right now consumers are locked in at much lower rates than prevailing rates. We looked at really what would affordability, where would we get back to trend line? And mortgage rates would have to fall to roughly 4.5%. So quite a ways from where we are today to just get back to sort of a median level of affordability.
Ivy, have you done any studies that show how many people own homes who want to move but can't or don't want to because simply mortgage rates are too high and they don't have other options?
We haven't done a study to that, but I can point out that more than 70% of homeowners have a mortgage rate that is lower than 5% that hold a mortgage, and roughly half have a mortgage rate below 4.5%. So there's quite a bit of stickiness. And in many markets in the country, inventory has risen in the southern part of the country, mostly Texas, Florida. So there's more choices. But then the challenge is that consumers are worried that they're buying at the top. Whereas in some markets, like in the Midwest and Northeast, inventories are still very tight. So when people are trying to move, they're like, where am I supposed to go? There's not product on the market. So we have a bit of a tale of two geographies, as well as a tale of two price points, where the high end is doing pretty well and the entry level is still really challenged.
Ivy, this is really a conundrum because at the same time that everyone's saying we need more supply, when you hear from home builders, their sentiment is terrible. They can't seem to feel motivated to go out there and build. So what will motivate them to want to build, given the fact that there seems to be plenty of demand to buy homes and it seems like there's insufficient supply?
Well, I might beg to differ there, because overall today for the new construction market that accounts for about 15% of transactions, there is a very high level of speculative inventory on the market. In fact, it's near 2009 peak levels. So I think there's plenty of inventory, and builders are very motivated to sell homes. They do not want to sit on finished lots given very high carry cost, overall cost of sitting on lots. So they want to go vertical. The challenges are they have impediments from local governments that require many, many factors that keep them from being able to go vertical. So I can go through those, but the reality is that we need governors to pressure local markets to reduce those impediments, and then builders will be able to go vertical. So just one example is just getting a permit. Getting a permit or getting entitlements could take weeks or months in some markets. So it's really not the builders. The onus is on the local markets.
Ivy, well said. And great framing. It's good to see you. Thanks for being here. Ivy Zelman there of Zelman and Associates. Affordability is the centre of every single debate right now in this economy, and we'll have that conversation later on today. Delta Airlines CEO Ed Bastian catching up with Bloomberg TV and our very own Bramo at 12:10 Eastern Time. Don't miss that conversation. I've said this is the Delta Airlines economy. Half the country thinks it's Group 1. The other half is struggling to afford to pay the ticket to get in the main cabin.
Yeah, there are two parts of this conversation. On one hand, the government shutdown, just how quickly will it take for everything to get back to normal? Will we have our Thanksgiving holidays with our families? But then there is this question around the K-shaped economy and the fact that 60% of their revenue comes from the premium and loyalty aspects of their job. This highlights why they have been so successful, why they are the preeminent airline. And it goes to the question, how far can this go? Is this something that just structurally is the new reality that a lot of different companies are facing?
Are you diamond medallion? That's all anyone wants to know, Bramo.
I'm actually
it's a
not.
diamond medallion.
I'm here. How can I be diamond? Where am I flying to?
Got to do a lot of flying to make it diamond medallion, right?
I think that you'd have to do a lot of flying. I think I'd rather spend time with my family.
That's the highest status at Delta.
Yeah, there's
isn't it?
diamond,
Yeah.
and then there's sort of like the mystery categories.
Oh,
that
okay,
people
there's one
can
above
have.
that.
I'm sure that you don't even know how you can get it,
Okay.
where it comes from, but things happen to you. I do get a handwritten note, though.
Oh, do you? They
when I go
write something for you?
The flight attendant will say,
Okay.
thank you for flying, et cetera. There is this feeling that, loyalty really is the way to capture people and lock them in.
Looking forward to the conversation later on today. Locked in, 12:10 Eastern Time with Ed Bastian of Delta Airlines. Tomorrow, here's the lineup for you. Keith Lerner of Truist, Eric Johnson of Cantor Fitzgerald, Kevin Gordon of Charles Schwab, plus Tiffany Wilding of PIMCO. From New York City this morning, good morning to you all. Have a wonderful day ahead. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Day 3 at the NITO ATP Finals. Carlos Alcaraz remains unbeaten after a thrilling 3-set win over Taylor Fritz. The top seed fought back from a set down against the American, closing it out 6-3 in the third. Later, Lorenzo Musetti wowed the home fans in Turin with his first win of the tournament, the Italian closing out a dramatic victory 7-5 in the decider over Alex de Minaur.